Opportunities abound in the Democratic Republic of Congo, DRC. The country is endowed with arable lands, rich mineral deposits, and an insatiable market for goods and services required by the almost 100 million population. In April 2021, President Uhuru Kenyatta of Kenya and President Felix Tshisekedi of the DRC signed a bilateral agreement that would see greater collaboration between the two countries. The agreement culminated in a 15-day trade mission to the DRC organized by the Kenya and DRC governments and facilitated by Equity Group.
I believe it is a moment of rare regional and continental pride as we witness our local enterprises coming together in the spirit of one Africa, one people.
And the theme, unlocking trade, tourism and investment opportunities in DRC and the Great Lakes region, the trade mission attracted more than 300 Kenyan investors, entrepreneurs and small and medium enterprises SMEs. The delegates first jetted into Kinshasa, a metropolis that is home to more than 16 million people. They were led by Kenya's Trade Cabinet Secretary Betty Maina, Equity Group Managing Director and CEO Dr. James Mwangi, Equity Group Chairman Professor Isaac Masharia, and the host, Equity BCDC Managing Director Celesta Mukeba.
We are very, very entrepreneurial. We seek new opportunities, and I've actually met Kenyans who have been in this market doing business for a while already. So this is, I think, for me, a great opportunity, and we present the opportunity in Congo as an opportunity for Kenyans to come and set up here.
The Kenyan entrepreneurs, captains of industry, and government agencies representatives were joined in the business forums, exhibitions, panel sessions, and site visits by more than 2,000 Congolese counterparts who were also keen to forge business partnerships.
J'ai la ferme conviction que la mission commerciale RDC-Kenya visant à rapprocher nos deux pays est de nature à renforcer nos relations en matière d'échanges commerciaux transfrontaliers facilités à ce jour par la zone de libre-échange continentale.
It's not every other time you get such opportunities where people open doors, actually walk in, see the opportunities, come back home and invite you to go and see what is available for you to do. And you can see this is a very big team. We have farmers here, we have engineers here, we have architects here, we have doctors here. It's a whole team. Just come and look for a niche for yourself, deliver on that, partner with the people on the ground, and you're good to go. It's a very good thing that Equity are involved in this, and I must say congratulations for holding our hands and bringing us. We have a time now to sit back and say these are the opportunities that we had, and this is what we did.
Giving a comprehensive prospectus of opportunities in the DRC, Dr. Mwangi said the trade mission was advised by the need for business decisions to be made guided by facts on the ground.
Today we started the Kenya DRC trade mission. We brought 253 Kenyan entrepreneurs. They are being hosted by over 2,000 Congolese business people. And the objective is to get Kenyan entrepreneurs to see the opportunity in DRC. The second one is to forge partnerships and collaboration with entrepreneurs of DRC so that we promote joint ventures.
Dr. Mwangi put in perspective the economic situation in the DRC, illustrating that the vast country is where Kenya was when only 6% of the population was banked.
DRC, from the financial sector, is where Kenya was in the early 90s. We're talking about 6% of the population being banked. 94% excluded. So this is a market we can grow very rapidly, much faster than we grew in Kenya, where we moved from number 66 to become number 1 largest bank in Kenya.
What Equity has done, I think, is one of a first, because Equity has been able to demystify the whole trade across DRC.
Kenya's Trade Chief Administrative Secretary Lawrence Karanja lauded Equity for partnering with the DRC and Kenyan governments for what he termed as part of a greater vision of the Africa Free Trade Area.
Kenya is keen to enhance trade relations through COMESA, tripartite, and African Free Continental Trade Area. And as I've said, we are pleased to welcome DRC into the East African community, because by so doing, we'll be having a market of more than 200 million people within the East African region. That is a market, and I will be asking the people of DRC and the people of Kenya to look at that opportunity which is coming.
We want more of this because it's bringing like-minded people together. What is also the missing link is normally money. How do you de-risk an opportunity? Working with Equity as a partner, we're able to understand off-takers, we're able to de-risk by making sure that the money is available, we're bringing like-minded people together. Equity is a lubricant in all of this. And by facilitating and going at different government levels, we're removing a lot of wrinkles and allowing us to do business. Just love it.
Day-long discussions in sessions in Kinshasa, Lubumbashi, Goma and Bujimai addressed various topics with strong panels of experts analyzing their respective sectors. An exhibition site was annexed to the plenary where traders from both countries also had an opportunity to showcase their products and services. The delegates had an opportunity to network with their Congolese counterparts in matchmaking sessions and business site visits in all 4 cities. Equity BCDC MD Mukeba was at hand to discuss how the entrepreneurs can partner with the bank.
The DRC is a country of opportunity in the sense that the number of population, we are talking about 100 million people, and it's growing at least 3% per annum. So that shows the headroom in terms of growth, especially when we speak about 6% only the banking penetration. So 94% is the potential of growth.
It is refreshing to see that Africans are going to Africa, and we call them same as we call someone else investor. It is a very good thing. I love the mission.
Participants had a chance to interact and appreciate firsthand the opportunities that exist in trade, manufacturing, agriculture, mining, tourism, IT, among other sectors.
This mission is very good because it is also an opportunity for people of Africa to be together for that good business that we need to do between Africans. Equity Bank is now like a medium, between us in our invest.
Kenya's ambassador to the DRC, George Masafu, expressed his satisfaction with the mission.
Kenyan businessmen are not coming here to do business by themselves. They're coming to partner with Congolese partners here. So the bank is also going to finance the Congolese businessmen, just as they're going to finance the Kenyan businessmen. And we believe that with strong trade ties, the relationships between our 2 countries are going to be very strong.
Speaking at the Lubumbashi leg of the mission, Deputy Governor of Katanga, Jean-Claude Kamfwa, thanked Equity BCDC for the initiative to bring the Kenyans.
Je tiens donc à saluer l'implication du groupe Equity Bank et Equity BCDC dans l'organisation de cette rencontre qui, reconnaissons-le, revêt toute son importance comme étape cruciale devant permettre l'éclosion d'initiatives régionales, favoriser les synergies et la création de valeur pour nos deux pays et pour notre belle province.
Everything in Congo is an opportunity, if I have to say so. Everything is an opportunity. There's no field in this country you can tap in and not get successful. Everything, no matter what you think about. Because just take the population, 100 million. Who don't want a market of 100 million customers? It's ready available. You think of agriculture, you think of education, you think of medicine, you think of all the fields are in need in DRC.
Equity Group Chief Commercial Officer Polycarp Igathe said the mission has opened doors for Congolese entrepreneurs to visit Kenya.
We come to seek partnership. We come to embrace you, to give you a normal African hug, and to shake hands as equal partners. So we expect that there'll be a lot of business from DRC coming to Kenya and a lot of Kenyan business coming to DRC.
At the opening ceremony of the Goma conference, the governor of North Kivu, General Constant Kongbanima, said the DRC government is setting up economic zones to attract foreign direct investments.
Et vous souhaitez la bienvenue à l'occasion de la cérémonie d'ouverture de la mission commerciale Kenya-République démocratique du Congo 2021. En effet, cette mission organisée conjointement par la République sœur du Kenya et de la nôtre, regroupant plusieurs hommes d'affaires, tant kenyans que congolais, a pour mission la promotion et la consolidation des relations commerciales et économiques entre nos deux États. A conduit cette mission et aux hommes d'affaires kenyans pour le choix judiciaire de la République démocratique du Congo comme destination de prédilection pour les affaires en général et en particulier la province du Nord Kivu.
Equity Group CEO Dr. Mwangi said the bank has set aside $5 billion for entrepreneurs to invest in farming, tourism, manufacturing, logistics, among other sectors.
There would be no better force of changing Africa than the business community. The business community, all entrepreneurs, organizes resources, takes the risks, and create products and services for the consumers, and in the process, they create wealth. The real cure to African challenge is wealth.
Citing Serena Hotel, Goma, as an example of cross-border investments, Dr. Mwangi said Goma and the surrounding region has a huge tourism investment potential.
Hasten your steps and invest in DRC. The tourism opportunity here is big. I was envious last night to see the hospitality in the lake. It's only by collaboration and partnerships that we can progress and take the continent to the next level.
East and Central Africa region has a long history of trade that has continued to the present. Indeed, the DRC is the sixth largest market of Kenyan goods.
Beyond having an embassy, we have now brought in a commercial attaché to confirm the importance of this region, Goma region. From the month of October, we started direct flights from Nairobi to Goma. When we started, we were doing 2 flights a week.
Although the Eastern DRC has been the subject of news on insecurity, the delegates learned that intensity of conflict is low. In Bujimai, the governor of Kasai Oriental, Janet Muswamba, said Equity BCDC is an asset. She said the province has the longest section of the mighty Congo River and there are opportunities for investments in agriculture, mining, tourism, water and energy utilities.
Je voudrais également saluer les membres du gouvernement provincial et plus particulièrement celle des opérateurs économiques de ma province, dont la présence traduit tous les intérêts qu'ils attachent à l'ouverture au monde, à travers les échanges commerciaux pour des conditions de vie meilleures dans notre espace commun.
The partnership between Kenya on the eastern seaboard of the Indian Ocean and the DRC on the Atlantic Ocean has opened age-old trade routes. For the delegates who participated in the trade mission, the initiative was an eye-opener that will herald a new beginning for Eastern and Central Africa.
Mkutano unakuwa nzuri kwangu kwa sababu ninakutana na entrepreneur wa kutoka Kenya, na ninajua ya kama tutafanya mapartenaria, ile tunaita partenaria, kwa sababu niko frame international, najua kama nitakuwa international kabisa, kwa sababu pamoja na entrepreneur kutoka Kenya tutaungana pamoja na tutaendelesha uchumi wetu kwenye Kongo pia na kwenye Nairobi.
I would like to add the Kenyan population, the people who can do business here in Congo. There are a lot of opportunities here. Please come and let's move together. Let's exploit these opportunities so that we can move forward as a community in Kenya.
A big appreciation to the government of DRC and to the government of Kenya. First, and bringing
Now I'd like to invite our Group MD and CEO, Dr. James Mwangi, to welcome us, say a few words, and to set the tone for the day. Dr. Mwangi.
Thank you very much, Joy. It's really a pleasure this morning to welcome our guests, analysts, investors, shareholders who have joined us for the week. It's been long coming, bringing investors on the ground to have a perspective of operating environment and put faces to the people who have been learning the bank. We know our investors have interacted a lot with Brent, they've interacted a lot with Mary and myself, and now we'll have a chance to interact with the leadership this afternoon. Like we shall also interact with the leadership in DRC so that behind the numbers, we can put faces of the people who deliver those numbers. It was very interesting and exciting to see you last night. And as the conversation started, we felt the enthusiasm and the confidence the Honorable American Ambassador had about what is happening in Kenya. Just to recap for those who were not there, she joined on the week of our elections last year in August. I was seated there when the results were being announced, and she formed a very positive view of the transparency of the election system in Kenya and the outcomes and then the legal process of a challenged election, suggesting an evolving and maturing organizational structures, whether it is the legal systems, whether it's the electoral systems or institution. And that is very fundamental for any operating environment. Are the institutions in place? Can the institution hold? And that was her first experience. And then from there on, it was the American interest. Quickly following that was the American African Leaders Summit. And there again, huge talk of the collaboration, of the partnership. But what has amused us is the amount of focus America has had, particularly in Kenya. Almost every other month, there is a high-level American leader who is in town. And we have seen that it's not just America. During the last 6 months, we have seen the president of France, Prime Minister of Germany, Japan, Singapore. Last week was Iran. This week we are hosting 18 African leaders. We have the American Secretary of State Trade. And the question is the significant agreements that also have been signed and where they are. And we have tried to put this in perspective. And this is our view, which we would like to persuade you to evaluate, that the global economy is going through a reset. I will say it again, because that's heavy, that the global economy is going through a reset. That reset started with the COVID, the disruption of supply chains, exposed over concentration and over dependence, and as a result, particularly of manufacturing. Most countries could not get PPEs, most countries could not get vaccines, and that brought the question whether the global structure or economic structure was sustainable, where a disruption by a health pandemic stops supply chains. And I think there is a big case for national, regional supply chains. And I think when we are seeing this movement of capital, we are seeing significant investment being proposed, whether it's like the recent Moderna in Nairobi for vaccines. It's simply because people can no longer trust on global supply chains. And the question that we have asked ourselves as a leadership team, if we move away from the concept of competitive advantage and economies of scale, what will happen to the cost of supplies? Are we then saying inflation, which is supply-driven, will be with us for a long time? Because national supply chains can't deliver on the same cost basis with supply chains that have been set up using competitive advantage and economies of scale. So that's a central question. The second disruption was the Ukraine-Russian conflict, and Africa was very dependent on particularly Ukraine and Russia on fertilizer, series of grains. It was Europe was very dependent on gas, and of course that again exposed the concentration of agricultural produce, like we had seen with manufacturing. And of course, global reset became necessary because that was an urgent issue and has significant ramifications. And we saw countries like Ethiopia, within a period of 3 years, triple its wheat production and become an exporter, a country that was a net importer. We have seen Zambia, Mozambique, even Zimbabwe pulling up through food. We have seen countries like Kenya distributing fertilizer to the farmers, and I guess this year Kenya is planning for maybe the highest yields of maize crop in many years. So we can see the reset is gradually happening. I think the issue of climate change might be the biggest driver of global reset. Looks like it's the challenge of our generation. It's what the world is focusing on. But if we have to really resolve that problem, Africa must play a very significant role because it holds 60% of the world's global cobalt production, 32% of the world copper production, and lithium, a sizable proportion of world, and of course, the 4 Ts. Are they 5 or 4 Ts? So essentially, then we start seeing that the supply chain has reversed in terms of raw material. And the question is, will Africa seek an equitable contribution by adding value on these strategic green minerals? And if that is to happen, and that is why the conversation in the US about the coalition of the strategic, it's called the strategic minerals. Everybody has formed alliances for strategic minerals. And the question is whether Africa would also create an OPEC kind of association to manage its natural resources and hopefully us. All this we see playing a significant role. And the Africa positioning itself with the African Continental Free Trade Area, larger markets, and we have seen what the East African community, the most integrated market, has done, bringing 300 million people and giving an opportunity to institutions like Equity to become billion-dollar economies. You can talk of 13, 14 billion-dollar companies. So we are now starting to see the market giving us huge opportunity. We are hoping that will happen to manufacturing. We are hoping that will happen to scale in all the other sectors. That that reset in every aspect that we have discussed is then supported by the global theme of dealing with poverty. And the question, you can't deal with poverty in the world without rebalancing. And rebalancing can only mean developing Africa, transforming Africa. You can't deal with African poverty without putting this. So all these subjects, we are watching them carefully, and we are seeing as if puzzles and pieces are taking shape. And the question is whether you could strategically position yourself as an organization, and whether as a leading organization you can provide leadership. I know this will only make sense if you contextualize it in terms of the economic environment or microeconomic environment we are operating in. And I guess it's clear to people that all this reset is being pushed back by the macros, the environment, where inflation, exchange rate have their say, and determines how far the efforts that are being made can be achieved. But we can see the underlying a change, maybe slowly, maybe held back by macroeconomic global environment, but you can see the initiatives. I think we are also seeing significant development of infrastructure in the region. We are seeing political will. We are hearing pronouncements that seems to suggest leadership has woken up to the reality. They are being more bold to what needs to be done. And that is the mix of issues that we have put on the table. Considering all this, we asked ourselves, what will we be doing? And one of the big thing we did was then to have deep knowledge of our environment. And we were lucky to get Yvonne Muhanga, most known by most of the economy. Yvonne, you can come forward a little bit, to join the group and help us deepen our research capabilities, but more important, economic analysis of the markets we are operating in, and to also link that with global trends. So she carries the position, or occupies the position of Chief Economist and Director of Research, and hopefully you benefit from her first research paper as we go on, so that then we can discuss our view. Thank you very much, Yvonne. Then we challenged Brent whether we could think strategy differently, and said if the world is resetting and Africa is becoming an important player, and that East and Central Africa has significantly integrated, and that it's the fastest growing region in the world. Can we position ourselves? And this was ambitious, but equity has never been anything less. And we put up what we called the African Recovery and Resilience Plan, and asked ourselves, if Africa is to benefit from this reset, what will happen? And we saw Africa quickly recovering from where it is, becoming very resilient, and sustaining very rapid growth. And we asked ourselves, how can we position ourselves as an organization? What would we be doing, and what would be very important? So we wanted to contextualize our conversations with the central bank governor, with the PS Finance, and in the evening with the cabinet secretary, and put perspective of what we heard from Ambassador Maggie last night in light of this context, and also then hopefully help to understand. So I want to invite those two. I don't know who goes first, whether it's the plan or it's the macro? Yvonne, you go first or Brent goes first? Are you sure it is Brent? And then try to justify why he's doing that through macro. I'm trying to find out what would be easier, Brent. Would it be easier we understand the environment and then the plan, or we understand the plan and then put it in context of the environment? Yvonne? Brent wants to sue. So, as a group, which now is made up of 4 groups. There is the banking group with the 6 banks and a rep office in Ethiopia. There is an insurance group with a life insurance and approval in principle for general insurance. We have an investment bank in the banking group. We have a technology group that has a PSP license, an MVNO, and of course APIs and web-based payment system. And then of course there is Equity Group Foundation, which really de-risk at the bottom of the pyramid, that capacitate the bottom of the pyramid and act as a catalyst of recruitment and mobilization of customers and onboarding them and risking. So that is the context of this plan, where each of these groups can play a very significant role in an integrated plan, very integrated, and on a regional scale, supported by trade, supported by investment across border, both local and international, but more importantly, supported by the common market framework and the African Continental Free Trade Area and the alignment of legal instruments, whether it's the monetary and fiscal policies with the entire region, and a population of 300 million. We thought it prudent when we talk about Africa, as Maggie said last night, Ambassador Maggie, let's focus on East and Central Africa, which has fewer challenges, and see whether we could pilot test the transformation of a continent on that basis. So I invite Brent to roll out the thinking, so that as we take this trip, as we interact with management, that can be the subject that you can seek to understand more, because that's how numbers will be generated, that's how business plans will be developed, that's how budgets are developed. So it's the bigger picture. Brent, an hour, including questions. Thank you. For those who might not have met Brent before, Brent is our group director of strategy. He joined us from Morgan Stanley. This is his 7th year and has been in charge of investor relationships, strategy, and of course helps to create tension between research economists and the reality of our business plan. Brent?
Good morning, everyone. So I'll take you through a presentation that will hopefully allow you to visualize the direction that Equity Group is going for the next couple of years. But maybe just to highlight, you would have seen over the last few years a number of activities that Equity Group has been undertaking, whether it's trade missions to the DRC, bringing European countries to Kenya, to the DRC, to Uganda, taking Ugandan businesses to DRC. You had also seen activities where we are partnering with manufacturers of agricultural equipment. You would have seen us doing a lot of initiatives in training small businesses. These are all pieces of a puzzle that we are piecing together. And to help you visualize how this bigger picture looks like, we'll take you through this plan, which we've called the Africa Recovery and Resilience Plan. And ultimately, It's really underpinned by the corporate philosophy of Equity Group, which is social and economic transformation. But importantly, in the execution of the plan is the business model. So I'll quickly run through the business model, which is particularly for the investors and the analysts. This will help you appreciate some of the outcomes that you see every quarter in terms of our investor briefings. And ultimately, this is what helps execute the numbers that we report on a quarterly basis. Historically, Equity Group has driven financial inclusion in Kenya and across the markets. But with this Africa Recovery and Resilience Plan, what we are looking to do more intentionally is to focus no longer at just the customer, but at the ecosystem as well. So this Africa Recovery and Resilience Plan that we have is underpinned by 6 strategic pillars, and it somewhat brings together the dynamics that James colored out earlier in terms of this global reset where countries, governments, businesses are looking to diversify their supply chain. So this speaks to raw materials, and that speaks to our pillar 1, where we operate in a region that is well endowed both with agriculture as well as with mining. We operate in the DRC. Our objective there is to improve productivity and output, and it speaks again to why we are partnering with manufacturers of agricultural inputs, whether it's fertilizers, chemicals, seeds, and also with the manufacturers of tractors and agricultural equipment to mechanize smallholder farmers. As James highlighted, for us to really have transformational impact, we really have to add to these raw materials that Africa is well endowed with. So that speaks to our pillar 2 around what we're doing with manufacturing and logistics. As we communicated to the investor community, there is a big focus around manufacturing. And the manufacturing sector, when we look at the markets we operate in, and if we look at the trade corridors, the economic clusters that are taking place in a country like Kenya, the manufacturing sector will become these anchors to these ecosystems. So there's a big focus for us to increase our loan book to become 15% manufacturing. On the food and agri side, we want this to be 30% of our loan book. As I go through the pillars, you'll notice that each pillar provides a foundation for the next. So the raw materials provides the foundation to what we're doing with the manufacturing. And then pillar 3 is about trade and investment. And it's basically one of the activities under this pillar is what we're doing over the next week. Bringing investors, businesses, and making them aware of opportunities across our region. And trade and investment is really focused on stimulating the trade between the countries we operate in. One of the big areas that we are focused on is around trade finance. Over the years, we've enhanced capacity, capability in our trade finance teams, and that's to really realize the benefits of the synergies between the countries. All our operations operate in the East African community. We're in all the countries with the exception of Burundi. These countries are increasingly becoming the most integrated bloc. If you look at the East African community, if you look at SADC, if you look at ECOWAS, and if you look at the North African trade blocs, the EAC is between the 7 countries. Our pillar 5 is about connecting smallholder farmers, which is part of our pillar 1 initiative. We have 18 million customers. A large part of those operate in the agricultural sector. It's about connecting the informal sector to the formal sector. A big part of the initiative of the Kenyan government is to formalize the informal sector. One of the big initiatives is to broaden the tax base. you'll get a sense that a lot of our initiatives is aligned to the policies of our governments. So Pillar 4 is we want to connect the small businesses to those in Pillar 1, Pillar 2, and the trade corridors that we are stimulating in Pillar 3. It also gives you a sense, again, for the investors, why we are looking to acquire a bank in Rwanda. This is not it. We get questions on it's a small country, but as I mentioned, it's a country that is part of a very integrated market. When you think of the EAC, you think of 300 million people, and a GDP of around $300 billion. And Rwanda is one of those markets. Our Pillar 5 is where our foundation plays into. For us to commercialize and to formalize small businesses, smallholder farmers, there's a level of capacity building that needs to take place. So this is where our foundation, with their initiatives around Wings to Fly, where we send kids to secondary school or to high school, our equity leadership program, where we send kids to university, what we do with social payments, what we do in the agricultural space. This helps us make the informal sector fit for purpose. And then Pillar 6 is about accelerating what we do in our previous 5 pillars. So we're working with a number of global technology companies to essentially help us digitize, connect these ecosystems. This just helps you put some statistics in what we've done with this business model, where we have a social engine, which is essentially our foundation that executes our Pillar 5. And then our economic engine is what we do in our banking, and more recently we've entered the insurance space. We want to offer an integrated financial services solution to our clients. So the social engine helps catalyze the economic engine, and the economic engine helps us scale up what we want to do. And you can break down our social engine into 2 parts. One is capacity building, the other one is supporting communities. We execute this social and economic engine business model of ours through an ecosystem approach. And this is very important because in the case of Kenya, where it's really transitioning from what was a public sector funded growth, infrastructure-led growth, to more private sector consumption-led growth, there's a transition taking place. There will be teething issues here and there, but essentially a transition is taking place where the users of the infrastructure will be the beneficiaries of the next phase of growth in Kenya. With this in mind, you'll have deeper value chains taking place, and this ecosystem approach that we have, where we've already done the heavy lifting of getting 18 million customers, largely in the micro, small, medium-sized sector, the way we execute and support customers is through this ecosystem approach, where we come with the corporate banking team, the micro, small, medium-sized team, and we provide an integrated, holistic solution to a value chain. And if you think of it, a loan to a distributor, which is a micro, small-sized business, is a dollar cash sale to a corporate that is selling to those distributors. So Equity Group has positioned itself as the gatekeeper to the bottom end of the pyramid. You'll see what is in red is essentially our social engine, helps capacitate the value chains that we are targeting. And then on the blue blocks is essentially our economic engine, both of banking and insurance. So there's a real intentional approach of why we're going into insurance. I won't go through this. I think James has somewhat talked about why Africa. The ambassador last night spoke about why Africa. So I won't go through this. I think the statistics are there. But there's clearly a productivity gain that is taking place in Africa, whether it's through access to financing, access to infrastructure, that's there. This presentation will be made available, so you don't have to spend too much time trying to memorize and take notes of it. The other aspect is the demographics. A quarter of the world will be in Africa in 2050, a significant part of the world's population, and ultimately market will be in Africa. There is a question around disposable income and purchasing power, but this is a market that is urbanizing, and indeed disposable income will improve over time, especially if transformation does take place. Natural resources is a key focus, as James highlighted. The pandemic, Ukraine-Russia has disrupted supply chains. And Africa provides an abundance of raw materials. I won't go through this. Again, a lot more statistics. Another aspect of Africa that is a big secular driver, not just in terms of the productivity gains or the demographics or the natural resources, but it's also Africa is becoming more integrated and coordinated. So, and it's starting off with the economic blocks of the EAC, SADC, ECOWAS, and then the Africa Continental Free Trade Area agreement is expected to piece these economic blocks together. But more importantly for East Africa, you can see 12% of total trade across the 7 countries happen between the members. And this compares to the EU, where it's 57%. And increasingly, this is improving across all these economic blocks, and we believe EAC is going to rapidly increase its share of intra-regional member trade. Why now? James went through these statistics. The pandemic highlighted how concentrated global manufacturing is. I think the geopolitics is highlighting how concentrated manufacturing is. And this just basically puts statistics to, or numbers to that narrative. Ukraine, Russia, James talked about this as well. This puts numbers to that narrative, where you have more than 50% of staple foods being produced in 5 countries. And again, Africa, a country like Kenya, provides that alternative to manufacture and to produce agricultural produce. And that's essentially how Equity Group is positioning itself, is for this reset, for this change, where you'll have investment moving into countries like Kenya, Tanzania, DRC. These are big markets for us. These are markets where Equity Group has strong positions and is entrenching its position. I won't go through this. So what is Equity Group doing in Africa? Ultimately, the objective that we have is to change this equation, where you have Africa's share of GDP at 3%, its share of global emissions at 2%, share of food supply net of exports at 8%, but 17% of the world's population, and in 2050 it will be 25% of the world's population. And it's the youngest. If you look at the bottom right, you'll see it's the youngest population, highlighting it will be the next market to grow and to access, to sell your goods, but it'll also be the next labor force. It will be the next Southeast Asia in terms of productivity and affordable labor, I suppose, for the diversifying supply chains. I went through this. These are the targets that Equity Group is intending to have. We currently have just over 18 million customers. The intention is to have 100 million customers by 2030, and these are the targets that we've set ourselves. We've recently put in place a ESOP for all staff in the bank or in the group. The metrics in which staff will need to achieve and the group will need to achieve are somewhat aligned to these objectives. I've pretty much gone through this. As I mentioned, the EAC is over a $300 billion market, a population of 300 million, and then you can see the statistics of the rate of urbanization, mobile penetration, which Equity Group operates across. James highlighted the Equity Group is set up into 4 groups. The first 3 that I'll mention is part of our economic engine. That is the technology group, that is the insurance group, and that is the banking group. The 4th is essentially our social engine, and that's the foundation. And as you'll be familiar, Equity Group in the technology group has a strong mobile anchor or bias towards it. Now, you'll appreciate capital allocation for Equity Group. We're looking to allocate more capital into Rwanda. We allocated about over $70 million in DRC last year. We acquired the second and oldest bank in the DRC 2 years ago at a cost of around just $100 million. We are allocating capital in markets that are amongst the highest growing in the world, both historically and over the next 5 years. The East Africa region, the EAC region, is expected to be one of the highest growing regions in the world. For the Kenyan businesses, as much as there is a lot of challenges in terms of inflationary pressures, interest rate, despite that, Kenya is expected to remain one of the fastest growing regions, highlighting that the world itself is experiencing challenges, but on a relative basis, our markets are doing relatively okay. Again, a lot of statistics. Now, this plan of ours, we've broken it down into the various markets. Thematically, if we were to think of Kenya in one phrase, or if we put a theme to it, we see Kenya as this diversified economic gateway into Africa, given its infrastructure. So the debt that has been built up in Kenya over the years, it can't be ignored that it's been allocated to productive assets, into infrastructure. It has come at a cost. It has come at an increased debt burden. But with time, the ability to repay that debt, because these productive assets will generate a broader tax base, will generate cash flows over time, will allow government to pay this debt. So we see Kenya as this diversified gateway into Africa and a key anchor to the East African community. This just puts a snapshot on Kenya. It's built a number of manufacturing clusters across the country. It is a big contributor to intra-regional trade. And importantly, you'll see agriculture is 20% of GDP. Transport and storage is 10%. And manufacturing 9%. And there's an initiative by the Kenya Association of Manufacturers to push this up to 20% over the next few years. These are areas that Equity Group is focused. Capital allocation and resources and where we're building capacity is focused in these areas. Importantly, you'll see when you contrast Kenya with a number of African countries, with the exception of maybe South Africa, Morocco, Kenya is one of the more diversified economies if you look at the GDP structure as well as the trade structure. These are just some statistics on this transition that Kenya is going through. It's moving, as I mentioned, from infrastructure, public-led growth to what we are currently in some sort of transitory period or phase, and we'll be going over the next 10, 15, 20 years into a private sector, more consumption-led growth. You can see the contribution of private sector, if you look at the statistics, is increasing over time. And the way Equity Group has positioned its business, as Kenya broadens and deepens its value chains, for a financial services group will be well positioned in that phase of growth, where the value chains are broadening and deepening. And therefore the product capabilities require, or the financial solutions for these companies will be broader and deeper as well. So Equity Group is positioning itself for the next 10, 15, 20 years. You'll appreciate Equity Group makes decisions on a long-term basis. Historically, we were always asked, why are we allocating capital to the DRC? We want to show you so that, and part of this trip is to help you appreciate why Equity Group is allocating capital to DRC. DRC, thematically, we see this as a renewable energy hub and a breadbasket. There is about 80 million hectares of arable land. This is land that has significant high rainfall and significant agricultural potential. There's 80 million. That 80 million is larger than Kenya as the country. Kenya is about 55 million hectares. The size of arable land in DRC is 80 million. DRC is 4 times the size of Kenya. This just helps you visualize the size of, so on the right you'll see the size of DRC. It's essentially the size of the UK, Portugal, Spain, France, Italy, all of those countries put together. This just helps you visualize further the DRC, so I won't go through too much of this. It's 80 million hectares of arable land, and you can just see the size of that relative to the rest of the arable land around the world. Again, DRC is a significant, as James mentioned, has significant reserves in critical minerals. This just helps you appreciate and visualize that in numbers. There is challenge around infrastructure, and we've positioned and structured our business appreciating those constraints. I won't go through this, just puts the banking sector in perspective. Ultimately, there's significant potential in the DRC. Credit penetration in more developed markets is north of 80% to GDP. This is banking sector credit as a percentage of GDP is north of 80%, almost 100% for a number of countries. In Kenya, it's around 28%. In DRC, it's around 7%. These low penetration rates, whether it's low banking penetration, whether it's low food penetration, if you look at retailing penetration to GDP, if you look at cement consumption to GDP, in most of our markets, it's very low. So this again speaks to the opportunities that Equity Group is seeing, and we want to showcase these opportunities when we take in investors and businesses to DRC starting tomorrow, these opportunities. So I'll end it there, but this just helps to set the tone, I suppose, for the next few days as we hear further from government officials, from businesses in Kenya as well as DRC, and helps you to put the color in this picture outline that we are putting together for you. this Africa Recovery and Resilience Plan essentially takes into account what's happening globally in terms of this global reset, the changing of supply chains. It also takes into, it appreciates the dynamics in our markets and how we can connect our markets, Africa, to what's happening globally. And the uniqueness of Equity Group's business model in terms of its social engine and its economic engine somewhat differentiates our ability to execute what is quite a dynamic and multi-dimensional activities that is required for us to execute. So over the course of today, we'll introduce you, as James mentioned, to the senior management to help you appreciate our ability to execute this very ambitious plan. So hopefully that sets the bigger picture and sets a more granular picture also to show you how our business model will play into this bigger picture and why we've allocated capital and resources in the way we have. And also helps you to appreciate why we've done this investor stroke trade and business mission to Kenya and DRC. So thank you very much.
Thank you very much, Brent. And as you can see, this is the broad thinking. And we're asking ourselves, can we create an integrated plan that brings these all facets together so that if there is a global reset, we make it very easy, both for governments, development institutions, and private sector to work together, and hence the need for a coherent plan. We have been very successful in bringing quite a lot of partners. Each of the governments in the 6 countries, we have a plan together for country plan. How do you then zero in each country so that you then fund or power the trade based on what each country does, based on what it has a competitive advantage of. We have talked to the Bretton Woods institutions, alignment, development banks, alignments, and we are seeing really synergies coming together to the extent of now saying together we have flagship projects that you can see on the ground. And during tea break, I think there are quite a number of some mulos there that you can see projects that have started taking off in the countries in the region. And that signifies collaboration, partnerships to make things happen. We have partnered with the African Continental Free Trade Area. We have signed up with East African Community, SADC, and say, can we collaborate to facilitate this trade? And we're very excited. African Exim Bank has said, can we create an African payment system? And the central banks are now signing in. So the ability to bring people together then makes it possible for people to work in a coherent way. Joy, are we ready? So a couple of slides then to put this plan into perspective, putting the quantities together and imagining what would happen if we got it right. It's when then you look at the reality versus the potential. And that is the contrast we have tried to say, where is Africa today? What is the potential of Africa that then can catalyze the resetting and maybe provide Africa with an opportunity to become a major global player or to have an equitable position in global trade. So that perspective has made us then put together a lot of data and say, if you look at quantities, these are the quantities. But the natural resources and utilization, or the capabilities and utilization of capabilities, are too far apart. It's almost you are dealing with, at most, less than 5% of your potential. And the question is, what will this reset help Africa fully utilize its potential? And if Africa really utilized its full potential, and the potential is in factors of production, and we can talk about labor. By 2050, Africa will have 25% of the world population. That is not just labor, but that is market. So this is what we are calling the market opportunities. And we thought, I'm not sure we are together, Joy. This is not a presentation. Slide 1 to 5, and I think you did it the other way around. Slide 1 to 5, and from 23, leave everything else. Yeah. So essentially, we're saying, if Africa will have 2.5 billion people, what will be the meanage of that population? It will be to the tune of 15. If it became a market, it could be a market for a company for 50, 60 years as a consumer market. If it is to provide labor, educated labor, it can be labor for 40 years. And the question is that not a huge asset that all the other continents are struggling with? Aging population. Can we convert this into a demographic dividend? That is a big question that we are asking ourselves. Can it be the consumer market beyond being labor? If it becomes labor, it earns. And that earning then can be turned into consumption. So you can create a nice circular economy just based on one factor of production. If we could utilize that, Africa has 65% of all the arable land remaining to be utilized in the world. Food inflation is the biggest headache to the world. Can Africa be able to transform that arable land into agricultural produce? If it converted into agricultural produce, two things will happen. The labor that we have in the country, we are still, so we're talking about, at the moment, that's how the market looks like. But 2025, that's how the market is likely to, 2050, that's how the market is likely to look like. But look at where does Africa play? At global trade, only 3%. How do you play 3% if you have 65% of all arable land? You know, one can't really comprehend. Global passenger traffic, 2%. Manufacturing, 3%. Energy consumption, 3%. You can see the correlation. And food supply, 8%. Now, 8% of food supply when at the moment you have 17% of the world population. And that explains the issue of should Africa really justify hunger? If it has 65% but only producing 8%, it can't even feed itself, leave alone the market. So even if you don't export, Africa can feed itself and remove the import really pressure of currencies for food. You look the impact Ukraine had on Africa or Russia had on Africa. So it's this contradiction. The contradiction becomes even more clearer in East and Central Africa. And we are very lucky that we can act as a catalyst. And that's why we are putting 30% of our balance sheet to agriculture. When you look at natural resources, 30%, but manufacturing is only 3%. So this is the contradiction. You have the resources. If you add population there, which is both market and labor, you have everything. but you are not utilizing. And the African Recovery and Resilience Plan is to try and inspire. And with the seeding, the bank has put of $6 billion. Hopefully, then we shall see the sparks. And within no time, we hope the sparks. And we can see the sparks in the flagship project. Hopefully, within time, then the fire will acquire its own momentum. And then we'll start seeing a lot of change. Then we said, if we looked at this from an experience of private sector, how would the private sector be? And we thought we could share with you the example of Equity. Equity is a private sector representative. But look at what Equity has been able to do in that space. And the question, we are hoping the companies coming in that space will do this. Equity has been growing tenfold every 5 years. And that is why we are excited with the American ambassador becoming a champion of telling people, I've gone to Africa and I've realized the reality is different from perception. And the objective of this visit is to try and convince the investors that there is a case for Africa. Now, we are talking about from 1991. I joined Equity in 1991. Funding was 29 billion. Look, in 5 years, we went to 300. That is 10 times. From 300, we went to 1.6 billion. That's 5 times. From 1.6 billion, we went to 16 billion. From 16 billion to 160 billion. You don't miss, sustained for 5 years. We talk about elections, but there have been elections since 1991. There's no 5-year cycle that we haven't had elections. This is the reality of Africa. Then interest came, capping came 2016, but we still doubled from 160 to 336. Now look, during 2021, during the COVID period, we tripled from 300. The momentum, despite the size, we are still able to triple in 5 years. And you can see by 2026, I guess we will have doubled again. And that's what we thought the African plan would enable the private sector. And that's why we are willing to take the risk. And it's not just about funding. The question is whether you are able to convert that into loans. And we can see it's the same with loans. If you look at total assets, that then simulates this. And in March, we were at 1.5 trillion. As at June, we are now at 1.7 trillion. When we talk about the fastest growing region, it turns into numbers. There are numbers before those statements. But it's also more, it's a profitable business. From -4 to 10 to 55 to 1.1 billion to 12 billion to 24 billion to 52 billion. And we can see the first quarter is 17 billion. If we multiply 17 by 4, it starts then to give you an inclination that the momentum. So this is what we are seeing the possibility of happening with the reset. If the private sector take a bold step and know Africa has risks, but there are risks that you can manage. There are risks you can mitigate. And there is a business that can be done in Africa. And if the global reset happens, then you can imagine what will happen to companies like Equity, which have established themselves, have the infrastructure, have the brand, have built the capability. But it's not just growth in numbers, it's growth in values, in value. You look one share in 2000 through splits and bonuses. And this leaves out the dividend. We have been paying dividend out every year, except during COVID. You can see one share has become 600 shares out of just splits and bonuses because of the value being created. You only do splits and bonuses if the value is growing very rapidly. So in just 20 years, 23 years, the shareholders' wealth has gone up by 138%. So essentially, this is what we are saying. Can we repeat this in scale? And can we ensure it's a transformation of the environment, not of an entity? And broadly, that's why it is important to work with the government, to work with multilateral institutions. We checked this and said, and maybe the last one is that it will be important to ensure that as we use the business model, there is also a de-risking. Equity uses the foundation to de-risk. We can see what is happening in scholars. We have now put 55,000 top 1 percentile children who are needed through secondary education. And when you look at those ones, at Form 4, 86% are able to go to university. 18% of all those who go to university get first class. Then you start wondering, really, the labor you can build, the labor of the future. Out of that now, we have, I think, 761 kids in Ivy League, in the US. 218 are in Ivy League schools, 37 of them in Harvard. So you have developed the labor that can really power this Marshall Plan. When you bring 700 kids from the US back, really, they can really, when you invest in youth and train your young women and men, 2.4 million of them, then put money at their disposal, you start seeing the SMEs. And the SME starts really becoming medium enterprises. And you can see the medium enterprises are able to take $2 billion in terms of loans, and a high-quality loan compared to the market. But I wanted just we take one case study out of this, of health. And Equity decided, health is one of the biggest protectors of our customers, or de-risk customers. And we said 40% of default in loans happen when a health incident happens within a family setup. And we said, if that is the case, we will always have a problem because health is not well addressed. And we said, can we do health? Then we realized it was impossible to do the demand side without the supply side. And it dawned on us that out of the kids who have gone to university, 800 of them had done medicine. And I said, wow, these are our kids. Why don't we create a franchise for them? As we speak, 80 doctors from that cohort has opened 87 clinics. Last month, they attended to 73,000 patients. And then we said, 73 in 1 month? What about if we give them a health insurance policy? So you now have a supply side fixed, and you have a demand side fixed. And we said, there is no insurance that can be able to do, why don't we get a license? And that explains why we got a health insurance. Ajara is in the room, a managing director of Roadshow. Yeah, you can start. Tells me she can take responsibility to ensure we have the largest insurance, health insurance company, largest in how many years? 3 years. You can see. I said, Ajara, can that happen? She looked at me and said, James, credit drive, 9 months, we became the 11th largest insurance company in 9 months out of 25. So if we were doubting the number of Africa, like me, I was doubting Ajara becoming number 1 in 3 years. She told me I've already become number 11 in 9 months in a pool of 25 life insurance companies. Why? Because there is need, the demand is there. What has been happening is the supply side, and supply side can be done profitably. So this is how we did the insurance, combining what one would call, if you can give me back the slides, we then said, can we do this using the infrastructure of the bank? It's a very elaborate infrastructure, but then the economic engine of the commercial entities, can we align a social engine that can be able to utilize this infrastructure? And this is what happened to, I will be very specific only to health. And we said, and you can see the brown or red, for that matter, is where the 78 clinics have been set. If you look at that, that is the economic corridor of Kenya. That is the one that contributes to the GDP. Then we said, if we use the blended finance, we can team up with donor partners and put in the marginal areas clinics. So we have now donor-funded clinics in all the green area, and the white area have now been taken up by the economic engine, and the country is covered by, with clinics. With the country covered with healthy clinics, then you can the entire population using the branch infrastructure that we saw through bank assurance. These branches that the group has, the branches that the group has, this one, can distribute insurance policies to 18 million customers. And then you have visibility on the supply side. And that's, again, you create an insurance company. And that's what we are seeing. And to the investors, we felt we could have this dialogue of then where is equity going? Equity is going to regional expansion. Now 50% of the balance sheet this year will be outside Kenya. Then equity can diversify, not just region use, in product diversification. We think insurance will be as big as the bank in 10 years, the business of insurance. When you look at pension asset management, life insurance, health insurance, general, to secure the securities that have been pledged by the bank against fire and theft. Essentially, equity can grow very, very fast and then support and anchor the African recovery and resilient brand. Dr. John, is there anything else you want to add? Where are you? Dr. John? Corinne? Is not in the room. Nothing else. Brent, anything else you want to add on health? No. Very good. Ajira, anything else you want to add on insurance? Okay, you'll add when you ask the questions. You could have preempted the questions. So that's broadly where we are in thinking as a group, combining the economic engine with the social engine, using the social engine to capacitate and more recruit, at the same time de-risk those who are recruited through capacity building and risk management tools, particularly through insurance and training. So I think I will now invite Brent in front to take a couple of questions. Brent, is a mic for Brent? Mics if we have any, and for questions. We can also have a few mics to help those who want to ask questions. Very good. So Brent has a mic. Brent, you can sit instead of standing. You can. Investors, Brent is ready to answer questions on his African recovery plan and the the numbers that we are building up. Very good. The first question, there is also another hand here. So let's distribute the mic.
Thank you, Dr. Mwangi and Brent, for the presentations this morning. Yeah, I mean, clearly from the slides we can see the opportunities exist. Could you talk about how much capital may be required to take advantage of those opportunities, and how the bank will be seeking to raise that capital over the next few years?
John, you can also then join Brent in front. Capital allocation, and generation, and if we can also talk about how it affects the dividend policy.
So there's a couple of things. So as a starting point, Equity Group generates a high return. So internal capital generation is there. There has been historically an instance where Kenya, which has been the highest returning business, has supported the growth. So when you look at our financial statements, you'll see the dividend payout for Equity Bank Kenya has been much higher than the group payout to shareholders. That's because of the surplus of that going into capital injection into DRC, going into supporting the acquisition of Rwanda, and injecting capital in the past to Uganda as well as Tanzania. We expect those returns to continue. We kept on getting questions in the past on whether DRC is just a matter of growth and us planting flags on the ground. You'll see in our recent Q1 results that, and this speaks to the bigger opportunities that Africa highlights or has, and Equity Group is realizing those opportunities for the businesses, but for investors, the ability of a country or a subsidiary like DRC to internally generate capital with an ROE well above cost of capital highlights that this growth translates into high returns and therefore can sustain itself through internal capital generation. Another key part of our initiative, and it's part of this ecosystem approach and this targeting of deeper and broader value chains, is the non-funded income. Our non-funded income business, which speaks to what we're doing in FX, cash management, payments, that speaks to revenue streams that are less capital intensive. So the growth is there. So to the extent that the growth picks up, we'll obviously have to reassess the capital needs. But for the time being, the level of growth that we're seeing in this environment is such that we can support it internally.
Ideally, when we look Uganda, South Sudan, Tanzania, Rwanda, and DRC were all funded by Kenya. Now, all of them are self-sustaining. They don't need to be funded anymore. They have all reached returns closer to 30, with Rwanda breaching 35%. So they can now start paying back. So there is a huge possibility of us now using the dividend payouts from all the subsidiaries to fund diversification, while each subsidiary fund itself for growth, because we expect, like we have always said, DRC should be able to challenge Kenya by 2026. So that growth, it can fund itself significantly now. It's so I think Brent, but John, do you have a different opinion?
No, I think Brent has spoken too clearly. All the subsidiaries have begun to go over cost of capital, so they're all self-generating. With regard to dividend policy, I think we've stated it that we are looking to maintain a dividend policy between 30 to 50%. I think we missed that during the COVID period, but that was being conservative. The idea is to continue maintaining that dividend policy over the near term and the long term. Where opportunities arise, like we've stated, interest in Ethiopia, or opportunities come, we will be coming to shareholders over time to reach out to them and see how we can do that. But the idea is to maintain the dividend policy over the long run.
Yeah, I think it's important to highlight that we've given a range of 30 to 50%. the growth remains quite high, and that will give you a sense of where we will be in that range.
Good. Follow-up question.
So just follow-up. Like you rightly mentioned, DRC is becoming quite scalable. Many of the investors that I speak to, that is quite impressive, but at the same time an area of concern given the historic volatility, political, economic that we've seen out of DRC. So maybe can you just talk about some specific reforms that you have seen in DRC while you've been operating there that could placate some of the concerns that investors have?
We entered the DRC in 2015 when we bought ProCredit, a German bank, then added 2019, we added BCDC, aggregated the two 2021 to merge them to really cover national infrastructure and capability. Having been in DRC now for the last 9 years, there have been 2 elections that have happened during that period. We have seen the risks that we all see on newspapers. But one thing that we have realized is, as Brent said, DRC is the entire Western Europe. From Italy, including Switzerland, Spain, France, UK. I think, Brent, you left Belgium. It's inside DRC. So when we look at the risk of DRC, they are spread in such a territory. When I talk to them about the eastern region, they said, James, you are nearer Goma from Nairobi than we in Kinshasa. From Nairobi to where that conflict is 1 hour. From where that conflict is to Kinshasa, the capital, is 2 hours of flight. 2 hours and 15 minutes. That's the size of the country. So essentially the country will have challenges, but within those pockets of challenges are huge vast areas of opportunities. And essentially what we decided is, why don't we divide this subcontinent into 4 countries? So we have the Western, and we manage that as a region. Then we have the Southern, that is the Katanga, the mining region. We manage that as a country. Then there is the Eastern, which is purely agricultural, tourism, trade with the East African region. The Katanga region is mining, is manufacturing, is trading with the South African region. And then, of course, there is the Central region, which is starting out to become a major agricultural zone. So when you manage that, you find the challenges are balanced off. You can really focus on mining without major challenges. You can focus on consumer lending in Kinshasa's 16 million population city in the West. You can do government banking in the West. So bearing in that in mind, then you can see how we have tried to diversify and mitigate the risk by putting weight on the region that with the lowest erosion from risks. The second thing is we have seen DRC only make one trajectory, improvement. Whether it is because it's a critical country in the global economy, whether it's because of climate change, the largest lungs now for the world in terms of carbon sink, in terms of the Congo Basin forest, the global interest in that, whether it's because of the natural resources, we are seeing concerted global effort to support the DRC to continue making progress. And what we have seen over the last 9 years is a greater resilience for the country, greater resilience for the people, and a greater progress. We see like the banking industry was the most challenged when we went there, and I think we have seen 11 reforms passed through the central bank and parliament. You see the central bank has been strengthened, resourced from a very senior manager from IMF, and as bankers, you then start speaking the same language with the bankers. We have looked at the monetary policy, and maybe Yvonne, you can jump in here, and so that you can put this into also perspective. What the reforms that you are seeing, the IMF program that DRC is in, but as you said to Brent.
So, as James mentioned, we've been there since 2015, and between 2015 and 2019, when there was a protracted delay in the elections, Equity Group was able to compound its balance sheet on a 4-year basis around 55%, and over the same period we were able to grow our P&L on a compounded basis of around 70%, in spite of the challenges in terms of the elections that was delayed for well over a year. It's not to say that will happen again, and it's not to say that the elections are scheduled for December. The expectations on the ground is that it will take place in December. The DRC went through its first transition of power in the last set of elections. For us, that was the turning point of how elections will take place in the DRC. And we expect that to continue as we go into the December elections.
John, anything you want to add?
No, I think the only thing to add with regard to the DRC now is the kind of support that you're seeing from the community around Africa in relation particularly to the EAC and the support that the country is having, even with the destabilization that you're seeing in the East. I think that participation of the regional players in trying to find solutions for the DRC is something that we haven't seen in the historic past. And I think that, combined with the kind of success that the country has seen over the last few years in terms of financial inclusion, if you look at the budget, what has happened to it, the kind of environment that it's created, we see stability going forward, and that should portend very well for growth in financial inclusion.
Yvonne, IMF programs in DRC and the economy generally.
Okay, yes. So on the DRC, just to your original question in terms of reforms that we're seeing, so the country's under an IMF program, as you're probably aware. What we have seen this year is the convergence of the official and parallel exchange rates. We've seen the Congolese franc depreciate against the dollar by around 20%, and that convergence take place, which is encouraging. We're seeing the central bank intervene less in the market in terms of foreign exchange sales. So now the market has to source dollars from the market itself, which also contributed to that depreciation. And as a result, the central bank has been able to rebuild reserves. So we're sitting, I think, at around 10 weeks of import cover, which is still below the 12 weeks or 3 months that's recommended, but it is an improvement from the 7 months that was there about 6 months ago. So we are seeing some progress on that result, in that regard. Capital markets reform, I think they're trying to bolster capital markets. In the case of the DRC, it's a more long-term objective. On the growth front, as Dr. Mwangi has asked, we've seen significant expansion, as you're probably aware, on the extractive economy front. And that's the reason why we're seeing high single-digit growth out of the region. And also this year, encouragingly, it looks as though the non-extractive economy is going to see some pickup in growth from below 4% to over 4%. So there are some developments that are encouraging that are taking place, particularly under its IMF program. But in addition to that, the fact that the economy is growing quite robustly is also positive for the economy.
If we put perspective, when we entered the DRC, the budget was $2 billion. I think this year it was $16 billion.
Should be around that, yeah.
Yeah. So you can see The structures are getting in place. We have tested and see the journey positive. But I think it will be good to hear the voice of the Chief Risk Officer in respect of this. If we can give some Kitwekere a mic, maybe he could play. But recognizing that this is a high-risk area, risk management in DRC is amplified. Sam?
Yeah, thank you, James.
And you can feel free to come in front.
So, as mentioned, DRC, adding to the developments, is now part of the East African community and has an active EAC program, including in peace building in the eastern part of the country. DRC has an active IMF program, as indicated. It has drawn a lot of interest from global powers, the US, China, various other places, and of course across Africa. It's had regular elections, last 2018 election scheduled in December 2023, stable government, and various reforms, economic, starting to be rolled out across the country. It faces significant challenges, most importantly infrastructure and peace, but that's to be expected of a vast country. But as also mentioned here, the reputation of the DRC, especially insofar as the challenges are concerned, gets ahead of the country. You will have the opportunity to see for yourself going into DRC and form an opinion of what you see, but our own experiences, it provides substantial opportunities, and the story of Equity Group in DRC is testimony. The growth that has happened, the profitability that has happened, the caliber of people that work for the group in DRC. There is a lot of positive that over the years has been sort of submerged by the negative stories, which in reality are isolated to certain parts of the country geographically. So we are quite optimistic about the country, not to suggest that risks are non-existent. They're there, they're known, they're manageable, they're getting better. Reforms, both legal, regulatory reforms, the CEO has mentioned the central bank governor and the push that she is bringing to financial crime risk, for instance, new regulations coming out to control money laundering risks, corruption, and the like. So it is improving. The improvement is much more than has been recognized, but we hope that your visit to the country will be an eye-opener. Thank you.
Maybe, Joy, you could project our experience of DRC. The Strathmore presentation, there was DRC experience. So essentially, what we have also done is really make sure the skills and competencies in DRC can manage that risk. Like the Chief Risk Officer in DRC is the former Chief Risk Officer for the Central African Development Bank. So you get the right skills, the right competencies that and also competencies that understands the environment. So when we meet the leadership there, and you see it's not treated like a subsidiary. DRC is treated like a standalone entity with the complete capability that compares very closely to the group capability. Because one, as we said, we are managing 4 countries in one, so it is like a regional, we take it as a regional outfit. We are aware of the challenges, so you need the capabilities and competencies that would be able to match that capability. So that's broad. Wafula, are you in the room? Yeah. Anything you could say about the operating risk environment? Wafula is our group chief, operating environment, to manage the risk of operating environment. It's called compliance and what?
Internal control and compliance.
Yeah, internal control environment. What would you say about the internal control environment of DRC?
Yes, so what we're trying to do is to build internal control within every unit and every function, so that every unit is able to self-assess itself. So we're basically building the 3 lines of defense, where I'm in charge of the first line, then we'll have the policy owners as second line, and then internal audit as third line. So by strengthening the first line, we should be able to know what's going wrong in advance of audit or second line.
Clement, are you in the room? Clement is the one who has built the entire control environment. So we decided DRC is not, so we got our group director of special projects to really go with a team of 30 to DRC. And we are satisfied that the internal control environment is as strong as that of Kenya now. And the objective was, given that it's a challenging environment, we need to fortify from inside. So we have really strengthened the internal control environment, the oversight, and as Sam said, and we are seeing value is being created without the risk of being eroded. Have you put that graph? It's coming. Let it come. Alex, you should be helping us there. So essentially, we wanted to share with you just a pictorial thread of our experience since 2015, because then that is when you really put into perspective the opportunity and the experience. The reality of DRC is very, very different from what we normally see. Just put it, I will select what I want to show. So, Yvonne, anything else you would want to add into the conversation that you have remembered? No, Brent?
Not at this stage.
Yeah, I think it's important. So yes, there is risks, but hopefully this trip, as Sam highlighted, will allow you to independently assess whether the returns and the opportunities accommodate for those risks. And importantly as well, as we introduce you to the management, both here at the group level as well as on the ground with Celestin and his team, the ability to execute and manage a business in what is a challenging environment. So the whole objective of the next few days is really to showcase, one, not only the opportunities, but the ability to realize those opportunities and manage the risks whilst given the environments in which we operate in. It needs to also be highlighted that Equity Group has a relatively diversified portfolio of businesses. As James highlighted, by the end of this year, more than 50% of the balance sheet will be outside of Kenya. The intention is not that we want to make Kenya smaller. The intention is that Kenya will grow faster as well. So across the group, and James has been introducing management over time, has been to increase the capacity in appreciation of the evolving environment, but also the new business lines that we are bringing in. And with those new business lines and with allocation of capital to markets like DRC, the risk basket is somewhat evolving, and can speak to why we've hired people like Wafula, why we've got the enterprise risk team in place, as well as the sustainability team, especially given the ESG lens that we need to have in a country like the DRC.
And then when you look at the numbers, and maybe Mary and Tyler, you can talk a little bit about this, you see the quality of loan book in DRC compare favorably to Kenya, Uganda? Mele, do you want to talk a little bit about the quality of the loan book? When you look at the quality of earnings, 57% of the earnings in DRC are in non-funded income. So, but talk about the quality of the loan book.
Thank you, James, and good morning, all.
You can come in front.
Sure. The DRC, as we've been showing in all our investor reports, has been performing very favorably compared to the rest of our subsidiaries, even when it comes to loan quality. And I know there's always a lot of questions about what is our loan mix in the DRC. And with the acquisition of BCDC, we did acquire a corporate bank that did have largely more corporate loans. But our existing subsidiary before that was largely SME. It was about 65% SME. The mix did become about 50% corporate, 25% SME, and 25% consumer. And the NPL rate has remained below 8% consistently in the DRC. This is a very well secured loan book. We are building their risk capacity to be able to take on more SME loans. And we talk a lot about ecosystem lending. And the DRC is the best place to roll that out because we have a huge corporate franchise there. And we operate with a lot of trust because we did acquire the longest serving bank in the region. It had been in operation for 100 years. So with that kind of brand, we then can acquire that entire ecosystem and build that SME franchise because that's where the real economy is. The real economy is the consumer, the individual, and the SMEs. And that is where Equity's strength lies. So with that, we are building that risk capacity. We have been building it. It takes time to do so, which is why that loan mix has remained about 50% corporate. But that mix will change within the next 3 years, and that will not come with a compromise on the quality. So that single-digit 5 to 8% NPL ratio, with their coverage being above 80% consistently in that time. And that's above 80% on balance sheet provisions. We have not taken account of collateral. So if you add on collateral, that goes well into the 120, 130% coverage. So it's a very well secured loan book. We have built our risk-taking capacity in terms of our staff, how we evaluate the SMEs. We've taken a lot of what we learned in Kenya and taken it to the DRC.
So quality of loan book would be the best indicator of risk within a country. And the quality of the loan book in DRC is better than Kenya. The reason why, as Mary has said, we expect DRC to rival Kenya is because we acquired this 116-year-old bank with all the largest mining companies, but it only banked the mining company. It didn't care about the employees. It didn't care about the SMEs that populate the value chain, and that is what we are now harvesting. And that is why we can be confident of the speed of growth and quality of loan book coming from that, because it's an ecosystem. It's not, we can grow fast. Emmanuel McDay, are you in the room? Credit. The second opportunity we have seen, which had not seen, and likely we can see the non-funded income growing faster, is trade finance opportunity. And I can see the group trade finance director in the room. Shemeka, what is your experience in terms of growth opportunity for trade non-funded income, particularly trade finance?
Thank you, Dr. James. If you look at DRC, when we started the journey, in terms of revenue, the country was making about 400 million.
I can see a lot of people struggling. Do you want to come in front instead of, we have a whole week, so we don't need to start training on day one.
Thank you. My name is Kennedy Shimeka. I'm the Group Director of Trade and Working Capital for Equity. So DRC has been a very success story for us. When we started, in terms of revenues, the business was doing about 400 million Kenya shillings per year. This year, we expect to end at about 4.5 billion shillings. from a competitive point of view, DRC has now caught up with Kenya. The way we are set up in that country, we have both. We are the first bank to roll out the back office, middle office, and front office functionality. We've seen a lot of opportunities in the mining space, especially export financing, post shipment. We've taken advantage of the legislation which allows each exporter to return back 60% of the value of the mine that they export. So we continue to see the country doing very well from a loss perspective, from trade finance again, since we started operating. The NPL for trade still remains at 0%. So from a going forward point of view, DRC will remain one of the biggest trade country, not only for equity, but for the amongst, if you look at the African countries. Thank you very much, James.
So we are really creating an institutional capability, and that is what really helps. Once you create institutional capability, then you are able to manage with the environment that you are operating in. If we look at the numbers, Alex, I hope this time they will come through on DRC. We see that aspect where Shimeka says 4 years ago when he started 400 million and now is at, very good. If you look at DRC, this is DRC for you, deposit growth. And I guess deposit now, I think I've seen as if they have breached, David, a deposit 4 billion or 4 billion. So you can see how quickly they are growing. That's the deposit base. Look at the growth in profitability. And if that was last year, and now by first quarter, we were ahead of half of, so it means that by June, we expect to have outperformed the entire performance of last year. So it is not growth, it's profitable growth. It's value creative growth. If you look at number of clients, it is mirroring the group and growing maybe faster than the group. And hopefully we can see the contribution of DRC. If you look closely, it is clearly visible where DRC came in, helped us to weather the interest capping 2016 in Kenya. Remember, Kenya had to remain flat because capping was at sovereign risk, so we pumped all the money in government, but DRC helped us to build. During COVID 2020, look at the jump there. Again, that is powered by DRC, and we see what is happening. So the issue to us is risk management. And that's why to us is build capacity in the institution and manage the risk of DRC, but also diversify that risk. And that is why there is a focus to ensure the insurance business can really help the East African region to make sure that the wealth being created in the DRC don't turn this into a DRC company. It can challenge Kenya, the bank, but insurance, we can then combine insurance and banking in Kenya and technology and challenge the wealth that will be created so that it doesn't redefine the group.
Maybe just to also highlight that going into December, the business, the equity or equity DRC, the way it's currently positioned is that you have less than 50% of our balance sheet in lending. The balance is basically sitting in cash. Within the loan book, 50% is corporate, 25% is SME, and 25% is retail. Retail is largely payroll lending. So when you think about the risks going into election, and to James's point, it's really around asset quality. And you should also overlay this with our NPLs over the 2015 to 2019 period when there was delayed elections. So the business is defensive going into the elections, but that's not to say that we're concerned, but that just helps you further appreciate how the business is set up as we go into December.
Very good. There was another question here. Very good. 2 questions here. Very good. Yeah. Empower the might. Okay, give the person next to you so we can, as we sort this.
Okay.
Okay. Yeah.
Morning, everyone. Thanks for the presentations and the responses so far. So I have 2 questions. One is on trade finance, the current growth driver, and the insurance business. Now, for the trade finance, it's just really to appreciate, or we'll really appreciate a bit more color, especially around 2 things. What would you say is your competitive advantage as equity, BCDC, especially in DRC, when you compare to, say, number 1 and number 3 banks there? And the extent to which then you follow this trade financing route. Say, for example, do you have partners in China that you work with, for example, where a lot of these minerals go to? Yeah, because we do see the growth in the off-balance sheet items and the speak, but it's been good to appreciate then the extent to which this trade route or trade financing goes in terms of depth. Aligned to that, then how equity is positioning itself for some of the trades being rerouted from the historical routes through Kenya to TZ, because we are seeing a lot of talk around that, some of the routes from Uganda, DRC going through Tanzania, as opposed to Kenya as we are used to, essentially since independence. The second question is on insurance. Now, on this, forgive my skepticism, but the insurance sector has struggled a bit in the region and in Kenya. Insurance penetration in Kenya at 2.4% is the highest in the region, or so. So I'm just trying to understand what you think will help you grow the insurance business to be as big as you say as the banking group in 10 years, because the growth has been a bit slower than the GDP, but do appreciate that you've already registered strong growth so far. Thank you.
Thank you very much. Alex, look at the presentation with the support of Ajara, put the presentation on equity life. Ajara, you can set them, that's right. Shemeka, we are on you. What is the competitive advantage? But as Shemeka gets the mic, remember, Equity has chosen to be a systemic bank in all the markets it operates. It's either in Kenya and DRC and Rwanda, it's number 2 in 3 markets. In Uganda, it's number 3. So you can imagine what that means for cross-border trade when you're a systemic bank in an entire region. And then you consciously, deliberately drive trade, like the missions that Equity is constantly organizing to facilitate trade. That gives. The second thing of being systemic is the size of balance sheet. The size of balance sheet in each market and ability then to take the opportunities without having to syndicate with anybody. But it's the global reputation of the bank. Equity is ranked the 4th strongest financial brand on earth that has enabled us to get the right credit limits. One of the biggest problems of DRC, and most of the banks in DRC have no correspondent relationships. So they can't do trade finance because they don't have correspondent relationships. So that is what we have brought in. Our relationship with Rabobank and IFC and FMO has been very helpful because we are able to use their balance sheet to strengthen our credit lines. Such that we don't need necessarily to be confirmed by other banks because we are supported by IFC. So that has given us a huge opportunity, and we are likely. The last one is that we are the oldest bank in DRC since 1909. And consequently, all the large mining company, mention any company, they have accounts with Equity. So what they were lacking is the right tools. And so bringing trade finance in a digitized form has enabled them to do what they do in their home countries. Kennedy, what else?
No, thank you, James. In addition, like I stated earlier, is a structure that we deployed. If you look at most banks in DRC, still only have a back office functionality. We've been able to put in back office, middle office, and sales or front office functionality. We also have a group team that is supporting the country in providing expertise in terms of deal structuring and origination. In terms of our offering, we are offering all the, unlike most of the other banks, all the spectrum of the trade finance product, starting from what we call the traditional trade products, letters of credit. We also offer trade finance and specialized products. We talked about export financing, which tend to give us very high returns, and they are also less risky. We are also, like James has said, have a very wide network of correspondent banking, over 200, who are able to support most of our transactions that are going in different parts of the world. We've also positioned ourselves in order to follow the various trade flows in the world. For example, from South Africa, things like steel, from India, manufacturing equipment, and the UK. So from a positioning perspective, we will continue to be quite ahead of the competition in the DRC market. Thank you, James.
Maybe pass the mic to Reshma, and as Reshma comes forward, I think the biggest differentiator is the support we are giving these global mining companies. I remember the focus on from the world is sustainable mining, is sustainability, and so you come in front. What we have done is then to create a capability that those multinationals don't have, that then makes it attractive to only do banking with us because we can help them in meeting their sustainability. Maybe you could talk our approach.
So good morning, everyone. I'm Reshma Shah, the Group Director in charge of sustainability. And if you think about a lot of the mining companies that we work with, the product that they're producing is supporting us from a clean energy transition. But the processes, as we all know from a mining perspective, have significant environmental and social implications as well. So the approach we have taken is basically to work with the mining companies in terms of first identifying the environmental and social risks and then helping them through mitigating that. That helps them in terms of their international standing as well, ensuring on the governance side transparency. We've also been working with artisanal miners in terms of taking them out of the informal sector into the formal sector as part of that. But broader than that, when you think about the mining companies, they have a significant footprint. There's issues around land access, there's issues around community, there's issues around health, and that's where a big part of our foundation, the Equity Group Foundation, can actually come in, and we can provide as Equity a much bigger support system than just from the banking side. So we become a partner of choice working with those mining companies in terms of what they need to deliver, and also around the mining companies, the ecosystem and their suppliers as well is something that we can work with to not just support the mining companies, but around that as well. I'll be talking this afternoon a bit more about the sustainability, and we can expand on that at that stage.
So approach is more important, and that's really then because you are helping the companies to quickly comply in an environment that is difficult for them. But remember, we have the infrastructure and the partnership with the government, and so we're able to help the companies, and this is value added to them. So in return, they concentrate their business with us.
Maybe just to add as well, you'll also need to appreciate the structure of the banking sector. So in a country like the DRC, the largest bank, which has just around 30% of the market, is solely focused on the DRC. They don't have regional. If you look at our portfolio of assets across the region, all of our businesses are at least top 3, with the exception of in Tanzania. What that highlights is that we have balance sheet both in country, and because we have a consolidated balance sheet, we have big limits that we can participate in terms of large trade finance transactions. The fact that we are present in all our markets, there is at least 3 countries neighboring that market. DRC is now an EAC member. So when you compare us in DRC, the largest bank is solely focused on DRC. In Tanzania, the 2 largest banks are solely focused on Tanzania. They may have 1 or 2 subsidiaries, but they have limited scale there. The real potential of the DRC, Tanzania, Kenya, Rwanda, Uganda, is the regional position that they have, especially in a market like DRC, where there's 9 neighboring countries, of which we operate in 4. In Tanzania, they have 8 neighboring countries, of which we operate in 4. So that's one of the structural competitive positions that Equity Group has. We are a regional bank, of which most of the banks that operate in our region are not, with the exception of the Kenyan banks. And importantly, in those markets, we are in the top 3, with the exception of Tanzania. So that's what positions us for trade finance, but it also speaks to our reach in terms of what James mentioned earlier, in terms of our infrastructure that allows us to reach across the banking suite of products, not just trade finance, payments, cash management, lending, but also what we want to do with the insurance business. If you compare us with the other insurers, we have a very powerful distribution capability, not just for banking, but also for insurance. But I'll let Angela speak for insurance.
And then there was the question of the shift of trade routes from Kenya to us. It doesn't matter where the market goes, we are there. That's why we needed to be systemic. So when trade shifts to Tanzania, it's trade to Uganda, it's trade to DRC. If it is from Mombasa, it's trade to Uganda, it's trade to Rwanda, it's trade to... So whichever way you route, the bank remains the same. So this would help us to become now moved. We have moved from number 54 in Tanzania to number 12. So that shift can easily now help us to become a number 1 to 5 in Tanzania, because the customers will remain with Equity, because in Uganda, where they are headed to, in DRC, they are already in Equity. So that's where we see. Your confidence, Ajara, is challenged. That you have a mic behind you.
All right, thank you, James. And good morning, everyone. As James said, I'm usually in this position where people think that our intention on the insurance journey is a little bit bold. But maybe before I answer the question, I'd like to ask you a question first. And the biggest question is, when we say insurance penetration is 2.4% in Kenya, and that's true, do we realize that insurance penetration for real is actually closer to 90%? And that the real story, insurance exists, but it exists in the informal way. And every time I talk about this, I say that when you look at the journey of Equity Bank and how Equity Bank then became relevant, it was really about disintermediating the mattress, because a lot of the population then didn't have access to formal financial banking networks. So currently, the person I'm trying to disintermediate is actually you, because each and every one of you is a competitor in the insurance space. You're currently insuring your communities, you're insuring your families directly through your pocket. Every time there's a hospital bill, I'm sure you fundraise. Every time there's education or school fees, I'm sure you fundraise or you pay directly. And so when we talk about making insurance relevant, what we're trying to do...
And when there is a death, they contribute?
Yes. When there's a death, they contribute. And so when you look at it, actually you are an insurance company all on your own, with your own balance sheet, using your P&L through various forms of earnings in order to insure the community. And so when you look at what we're trying to do, I know that it sounds like it's a very big task, and surely it is. But if all the people in this room could take a minute to say that I will stop being an insurance company and I will trust Equity's balance sheet, which surely at 1.7 trillion is stronger than your personal balance sheet, then perhaps we can start the journey towards making a difference with insurance. So the biggest story really is that when we look at the daily community, each one of you has a life. And currently, as you work, your life is actually your biggest asset, isn't it? Second to that is your health. When you use your life and your health, you use that to create wealth, isn't it? So what we're trying to do is give you a comfort that for a small amount, a premium that you will be paying an insurance business, we would like to take that burden away from you and use the strong balance sheet of Equity Group in order to use a risk-pooling mechanism called insurance, so that then we can support the community to insure at scale. Now, when we started this journey of the insurance business in 2022, admittedly, as you can see from the slide there, it was an amazing 9 months. And what we wanted to do was to make sure that our secret sauce, which we shall share with you today, was truly well understood. If you look at, for instance, the Kenyan industry or East African industry, over 100 companies have been trying to come into the market, trying to crack insurance and not getting it right. So even for Equity Group to go into this space, we had to be very careful that we understand what are the issues facing the market, what would make us a truly relevant insurance business and partner for the community, how can we create a sustainable insurance business that adds value to the EGH performance and balance sheet? And then last but not least, how to create a business that can replicate the success of the banking group all across the regions in which it operates. So for the first 9 months, you can see we managed to underwrite actually one of the largest policies in the Kenyan industry, issued over 4.1 million policies. And in fact, the regulator called us and asked us, are you sure your numbers are right? You kind of distorted industry reporting. And what we did in the first 9 months was spend a lot of time to understand the Equity customers, understand what exactly do they need, because these policies have existed before. So we took time to understand what their needs are, what the gaps are with the current policies that exist in the market, and also we took time to understand why the previous policies were not performing. So some of these policies historically were performing with loss ratios of 138%, which means that the claims in any 1 year or the last 3 years was actually higher than the premium that was being underwritten. So we didn't go into it just to write business. We were very cautious to understand the market, understand the policies, understand the pricing and the risk that was being priced into those policies, so that at the end of the first year we can then say, okay, do we think that we have cracked this? And I'm sure you can see from the slide that we managed to crack this. Now, if I can give you just a few highlights, because I can talk about this all day. What is the biggest thing we're doing in the insurance business? As I said earlier, the reason you're all insuring yourselves is because you don't trust, right? A lot of people will say, I had a policy somewhere, something happened, and when a claim event occurred, the insurer didn't come through. So as we come into this conversation on insurance, we know that the challenge we're facing is a challenge of trust. How do we persuade ourselves and the masses that we are able to carry your risk sustainably? And of course, coming with that, you asked me how the biggest dividend we have as Equity is actually the brand. Equity brand, as you well know, has been known to be an inclusive brand. It has been known to challenge the norm. It has been known to focus on providing solutions to the masses in a way that makes sense. So compared with a lot of insurers who are known to be driven by profit, we are driven by purpose. And number one, we believe that presenting this brand to the consumers gives them a sense of comfort that this is a financial institution that means well. The second thing which we are doing on the insurance side is to be demand driven. Largely on the insurance business, you'll notice a lot of insurance companies will design policies and push them out to the customer, right? And the reason why we are very aggressive as insurance sales agents, yes, I was a broker before, is we know that we have to sell. right? And stories that told about people selling insurance policies in the parking lot close to the morgue when you've lost someone, because we know you're at your lowest point. We know you're very vulnerable, and we know that that is the right time to sell. But that tells you that a lot of the policies are designed to be pushed, isn't it? And that means the customer on their own doesn't see the relevance of the need for insurance. So the second thing we're doing is spending a lot of time with the customer to understand, what do you actually need? Remember, the need for insurance exists. We all have life, we all have health, we have wealth as well, isn't it? So the need is there. But the question is, how do we design our policies in a way that customers feel that it is relevant, and as such, they can then surrender a portion of their disposable income to then purchase an insurance product. So we've had a lot of conversations with the customers. In fact, I can say, Dr. James, we now have the first policy, funeral policy in Africa that has no exclusions, never been done before. So we don't have exclusions for things like suicide. We don't have exclusions for things like alcoholism, for group funeral, because we've studied the data, over 14 years of data, and we have seen that the claims that arise out of those events, which are usually excluded, is less than 3%. And so on certain policies, we can be bolder around inclusion to provide solutions that actually work, because statistically, we can see how to price for those. We've also been able to do things like buying back of exclusions. So a lot of insurance policies will exclude, for instance, if you're a biker or if you're a hiker, those are considered to be high-risk events, and so they're excluded from your policy. We believe you can buy back that exclusion, right? Pay a little bit extra so that you can live your life. We're a lifestyle insurer. So live as you wish, just pay the right premium. In the same case, when it comes to things like health, we're not saying don't have your glass of wine on Friday. We're just saying that as you have it, please pay a little bit more premium, because you might be more likely to have a cardiac event, that type of thing. So as opposed to pricing on average and restricting you with exclusions, we are pricing in your lifestyle into the policy. That way we know that we're going to become a truly relevant insurance solution partner. That was the second one, being demand driven. Now third, I can say one of the things we're doing as well, as Brent mentioned, is leveraging off the distribution channels of Equity Group. Again, just to give you some numbers. Currently outside Equity, the largest insurer in East Africa, if you look at the agency network they have, is 4,000 agents. That's, in our world, we call it 8,000 booths, right? The largest you can think of. Now, when you look at the Equity network outside the physical branches, Equity has over 300,000 merchants. Now, if you do 300,000 merchants times 2, that's 600,000 booths. We've not yet added all the other distribution channels. So we are saying, going in terms of being able to engage a consumer, we have a distribution network that is 14 to 15 times larger than the largest insurance business that currently exists in this market. Now, in terms of branches, physical branches, the current largest distribution of branches physically is 42. Equity within Kenya alone has over 150. And so what we're saying is, going into this conversation, we don't have to technically invest as much as any other new insurer to capacitate a network. What we have to do is ensure that our teams on the ground understand our products, have easy access to technology, so that they can engage the market much, much easily. And as I said, because this infrastructure already exists, really capacitating it would be done at a fraction of the cost. That would also mean administration becomes easier. And I'll give an example of livestock insurance. So a story is told in our industry of a cow. This is actually a real case in Kenya. A cow that died somewhere, I won't say where it is. Now, that particular cow was claimed over 300 times using the same picture, the same cow. And it's because the insurer was not able to realistically validate that it was the same cow. Now, with Equity's network, it is very easy for us. We have something called Equity Mtaani, for the agent in that particular area to be able to validate whether it was really one cow or not. So when we talk about the value of the distribution channel, it's not only about selling. It's not only about engaging the community to acquire customers. It is also about our ability to validate the claims that we currently receive. Currently, insurers are loss-making because, on average, 38% of claims are actually fraudulent. Ergo, the cow that was claimed 300 times.
So you remove 40% of your cost up front. And that is why Equity Insurance has no agents and has no brokers. If you remove agents, agents sell to you, but when the claim, the event happens, they are nowhere. You go through where the insurance is. Now, the branch manager, who has been your branch manager for 20 years, is the one doing bank assurance. So you know where to go, there is trust. The agent in your village is the one who is distributing the policies. I hope you can understand. And the question is, do you want to continue to be the insurance for your entire village, or you want to encourage your entire village to take a small premium? You pay school fees for everybody, you pay health policies for everybody, you pay funerals for everybody. You know, it's simply people have never had a solution. And that is why the numbers. I want to break there because I'm told the governor of the central bank is around the gate, and I wanted to give you a healthy break and also an opportunity to pick a cup of coffee. After the governor has presented to us, we continue with Ajara. Are you okay with that? So, Ajara, sorry for stopping you when the story was becoming better and better. I could see you were getting really excited to carry the crowd. I'll give you a chance later on. So, kindly let's use the next 15 minutes for healthy break, a cup of coffee, and thank you very much.
Opportunities abound in the Democratic Republic of Congo, DRC. The country is endowed with arable lands, rich mineral deposits, and an insatiable market for goods and services required by the almost 100 million population. In April 2021, President Uhuru Kenyatta of Kenya and President Felix Tshisekedi of the DRC signed a bilateral agreement that would see greater collaboration between the two countries. The agreement culminated in a 15-day trade mission to the DRC organized by the Kenya and DRC governments and facilitated by Equity Group.
I believe it is a moment of rare regional and continental pride as we witness our local enterprises coming together in the spirit of one Africa, one people.
And the theme, unlocking trade, tourism and investment opportunities in DRC and the Great Lakes region, the trade mission attracted more than 300 Kenyan investors, entrepreneurs and small and medium enterprises SMEs. The delegates first jetted into Kinshasa, a metropolis that is home to more than 16 million people. They were led by Kenya's Trade Cabinet Secretary Betty Maina, Equity Group Managing Director and CEO Dr. James Mwangi, Equity Group Chairman Professor Isaac Masharia, and the host, Equity BCDC Managing Director Celesta Mukeba.
We are very, very entrepreneurial. We seek new opportunities, and I've actually met Kenyans who have been in this market doing business for a while already. So this is, I think, for me, a great opportunity, and we present the opportunity in Congo as an opportunity for Kenyans to come and set up here.
The Kenyan entrepreneurs, captains of industry, and government agencies representatives were joined in the business forums, exhibitions, panel sessions, and site visits by more than 2,000 Congolese counterparts who were also keen to forge business partnerships.
J'ai la ferme conviction que la mission commerciale RDC-Kenya visant à rapprocher nos deux pays est de nature à renforcer nos relations en matière d'échanges commerciaux transfrontaliers facilités à ce jour par la zone de libre-échange continentale.
It's not every other time you get such opportunities where people open doors, actually walk in, see the opportunities, come back home and invite you to go and see what is available for you to do. And you can see this is a very big team. We have farmers here, we have engineers here, we have architects here, we have doctors here. It's a whole team. Just come and look for a niche for yourself, deliver on that, partner with the people on the ground, and you're good to go. It's a very good thing that Equity are involved in this, and I must say congratulations for holding our hands and bringing us. We have a time now to sit back and say these are the opportunities that we had, and this is what we did.
Giving a comprehensive prospectus of opportunities in the DRC, Dr. Mwangi said the trade mission was advised by the need for business decisions to be made guided by facts on the ground.
Today we started the Kenya DRC trade mission. We brought 253 Kenyan entrepreneurs. They are being hosted by over 2,000 Congolese business people. And the objective is to get Kenyan entrepreneurs to see the opportunity in DRC. The second one is to forge partnerships and collaboration with entrepreneurs of DRC so that we promote joint ventures.
Dr. Mwangi put in perspective the economic situation in the DRC, illustrating that the vast country is where Kenya was when only 6% of the population was banked.
DRC, from the financial sector, is where Kenya was in the early 90s. We're talking about 6% of the population being banked, 94% excluded. So this is a market we can grow very rapidly, much faster than we grew in Kenya, where we moved from number 66 to become number 1 largest bank in Kenya.
What Equity has done, I think, is one of a first, because Equity has been able to demystify the whole trade across DRC.
Kenya's Trade Chief Administrative Secretary Lawrence Karanja lauded Equity for partnering with the DRC and Kenyan governments for what he termed as part of a greater vision of the Africa Free Trade Area.
Kenya is keen to enhance trade relations through COMESA, tripartite, and African Free Continental Trade Area. And as I've said, we are pleased to welcome DRC into the East African community, because by so doing, we'll be having a market of more than 200 million people within the East African region. That is a market, and I will be asking the people of DRC and the people of Kenya to look at that opportunity which is coming.
We want more of this because it's bringing like-minded people together. What is also the missing link is normally money. How do you de-risk an opportunity? Working with Equity as a partner, we're able to understand off-takers, we're able to de-risk by making sure that the money is available, we're bringing like-minded people together. Equity is a lubricant in all of this. And by facilitating and going at different government levels, we're removing a lot of wrinkles and allowing us to do business. Just love it.
Day-long discussions in sessions in Kinshasa, Lubumbashi, Goma and Bujimai addressed various topics with strong panels of experts analyzing their respective sectors. An exhibition site was annexed to the plenary where traders from both countries also had an opportunity to showcase their products and services. The delegates had an opportunity to network with their Congolese counterparts in matchmaking sessions and business site visits in all 4 cities. Equity BCDC MD Mukeba was at hand to discuss how the entrepreneurs can partner with the bank.
The DRC is a country of opportunity,
in the sense that the number of population, we are talking about 100 million people, and it's growing at least 3% per annum. So that shows the headroom in terms of growth, especially when we speak about 6% only the banking penetration. So 94% is the potential of growth.
It is refreshing to see that Africans are going to Africa, and we call them same as we call someone else investor. It is a very good thing. I love the mission.
Participants had a chance to interact and appreciate firsthand the opportunities that exist in trade, manufacturing, agriculture, mining, tourism, IT, among other sectors.
This mission is very good because it is also an opportunity for people of Africa to be together for that good business that we need to do between Africas. Equity Bank is now like a medium, like between us in our invest.
Kenya's ambassador to the DRC, George Masafu, expressed his satisfaction with the mission.
Kenyan businessmen are not coming here to do business by themselves. They're coming to partner with Congolese partners here. So the bank is also going to finance the Congolese businessmen, just as they're going to finance the Kenyan businessmen. And we believe that with strong trade ties, the relationships between our two countries are going to be very strong.
Speaking at the Lubumbashi leg of the mission, Deputy Governor of Katanga, Jean-Claude Kamfwa, thanked Equity BCDC for the initiative to bring the Kenyans.
Je tiens donc à saluer l'implication du groupe Equity Bank et Equity BCDC dans l'organisation de cette rencontre qui, reconnaissons-le, revêt toute son importance comme étape cruciale devant permettre l'éclosion d'initiatives régionales, favoriser les synergies et la création de valeur pour nos deux pays et pour notre belle province.
Everything in Congo is an opportunity, if I have to say so. Everything is an opportunity. There's no field in this country you can tap in and not get successful. Everything, no matter what you think about. Because just take the population, 100 million. Who don't want a market of 100 million customers? It's ready available. You think of agriculture, you think of education, you think of medicine, you think of all the fields are in need in DRC.
Equity Group Chief Commercial Officer Polycarp Igade said the mission has opened doors for Congolese entrepreneurs to visit Kenya.
We come to seek partnership. We come to embrace you, to give you a normal African hug, and to shake hands as equal partners. So we expect that there'll be a lot of business from DRC coming to Kenya and a lot of Kenyan business coming to DRC.
At the opening ceremony of the Goma conference, the governor of North Kivu, General Constant Kongbanima, said the DRC government is setting up economic zones to attract foreign direct investments.
Et vous souhaitez la bienvenue à l'occasion de la cérémonie d'ouverture de la mission commerciale Kenya-République démocratique du Congo 2021. En effet, cette mission organisée conjointement par la République sœur du Kenya et de la nôtre, regroupant plusieurs hommes d'affaires, tant kenyans que congolais, a pour mission la promotion et la consolidation des relations commerciales et économiques entre nos deux États. A conduit cette mission et aux hommes d'affaires kenyans pour le choix judiciaire de la République démocratique du Congo comme destination de prédilection pour les affaires en général et en particulier la province du Nord Kivu.
Equity Group CEO Dr. Mwangi said the bank has set aside $5 billion for entrepreneurs to invest in farming, tourism, manufacturing, logistics, among other sectors.
There would be no better force of changing Africa than the business community. The business community, all entrepreneurs, organizes resources, takes the risks, and create products and services for the consumers, and in the process, they create wealth. The real cure to African challenge is wealth.
Citing Serena Hotel, Goma, as an example of cross-border investments, Dr. Mwangi said Goma and the surrounding region has a huge tourism investment potential.
Hasten your steps and invest in DRC. The tourism opportunity here is big. I was envious last night to see the hospitality in the lake. It's only by collaboration and partnerships that we can progress and take the continent to the next level.
East and Central Africa region has a long history of trade that has continued to the present. Indeed, the DRC is the 6th largest market of Kenyan goods.
Beyond having an embassy, we have now brought in a commercial attaché to confirm the importance of this region, Goma region. From the month of October, we started direct flights. Right now, we are doing 3, and we are looking forward to having daily flights.
Although the Eastern DRC has been the subject of news on insecurity, the delegates learned that intensity of conflict is low. In Bujimai, the governor of Kasai Oriental, Janet Muswamba, said Equity BCDC is an asset. She said the province has the longest section of the mighty Congo River, and there are opportunities for investments in agriculture, mining, tourism, water and energy utilities.
Je voudrais également saluer les membres du gouvernement provincial et plus particulièrement celle des opérateurs économiques de ma province, dont la présence traduit tout l'intérêt qu'ils attachent à l'ouverture au monde, à travers les échanges commerciaux pour des conditions de vie meilleures dans notre espace commun.
The partnership between Kenya on the eastern seaboard of the Indian Ocean and the DRC on the Atlantic Ocean has opened age-old trade routes. For the delegates who participated in the trade mission, the initiative was an eye-opener that will herald a new beginning for Eastern and Central Africa.
Mkutano unakuwa nzuri kwangu kwa sababu ninakutana na entrepreneur wa kutoka Kenya, na ninajua kama tutafanya partenaria, ile tunaita partenaria, kwa sababu niko frame international, najua kama nitakuwa international kabisa, kwa sababu pamoja na entrepreneur kutoka Kenya tutaungana pamoja na tutaendelesha uchumi wetu kwenye Kongo pia na kwenye Nairobi.
I would like to add the Kenyan population, the people who can do business here in Congo. There are a lot of opportunities here. Please come and let's move together. Let's exploit these opportunities so that we can move forward as a community in Kenya.
A big appreciation to the government of DRC and to the government of Kenya. First, bringing 250 companies from Kenya to come and see the opportunities here. And Equity BCDC being able to show us the way, telling us we've been here before 7 years, this is how we've been able to prosper, this is how we've been able to transform lives in this economy, and telling us, come, we want to do business with you. That is not something to be taken lightly, getting all of us here.
This was a very good call for both countries. And especially I thank Equity for facilitating this, because for many participants I've been able to talk to, is an eye-opener for them.
Hakuna matata.
Opportunities abound in the Democratic Republic of Congo DRC. The country is endowed with arable lands, rich mineral deposits, and an insatiable market for goods and services required by the almost 100 million population. In April 2021, President Uhuru Kenyatta of Kenya and President Felix Tshisekedi of the DRC signed a bilateral agreement that would see greater collaboration between the two countries. The agreement culminated in a 15-day trade mission to the DRC organized by the Kenya and DRC governments and facilitated by Equity Group.
I believe it is a moment of rare regional and continental pride as we witness our local enterprises coming together in the spirit of one Africa, one people.
And the theme, unlocking trade, tourism and investment opportunities in DRC and the Great Lakes region, the trade mission attracted more than 300 Kenyan investors, entrepreneurs and small and medium enterprises SMEs. The delegates first jetted into Kinshasa, a metropolis that is home to more than 16 million people. They were led by Kenya's Trade Cabinet Secretary Betty Maina, Equity Group Managing Director and CEO Dr. James Mwangi, Equity Group Chairman Professor Isaac Masharia, and the host, Equity BCDC Managing Director Celesta Mukeba.
We are very, very entrepreneurial. We seek new opportunities, and I've actually met Kenyans who have been in this market doing business for a while already. So this is, I think, for me, a great opportunity, and we present the opportunity in Congo as an opportunity for Kenyans to come and set up here.
The Kenyan entrepreneurs, captains of industry, and government agencies representatives were joined in the business forums, exhibitions, panel sessions, and site visits by more than 2,000 Congolese counterparts who were also keen to forge business partnerships.
J'ai la ferme conviction que la mission commerciale RDC-Kenya visant à rapprocher nos deux pays est de nature à renforcer nos relations en matière d'échanges commerciaux transfrontaliers facilités à ce jour par la zone de libre-échange continentale.
It's not every other time you get such opportunities where people open doors, actually walk in, see the opportunities, come back home and invite you to go and see what is available for you to do. And you can see this is a very big team. We have farmers here, we have engineers here, we have architects here, we have doctors here. It's a whole team. Just come and look for a niche for yourself, deliver on that, partner with the people on the ground, and you're good to go. It's a very good thing that Equity are involved in this, and I must say congratulations for holding our hands and bringing us. We have a time now to sit back and say these are the opportunities that we had, and this is what we did.
Giving a comprehensive prospectus of opportunities in the DRC, Dr. Mwangi said the trade mission was advised by the need for business decisions to be made guided by facts on the ground.
Today we started the Kenya DRC trade mission. We brought 253 Kenyan entrepreneurs. They are being hosted by over 2,000 Congolese business people. And the objective is to get Kenyan entrepreneurs to see the opportunity in DRC. The second one is to forge partnerships and collaboration with entrepreneurs of DRC so that we promote joint ventures.
Dr. Mwangi put in perspective the economic situation in the DRC, illustrating that the vast country is where Kenya was when only 6% of the population was banked.
DRC, from the financial sector, is where Kenya was in the early 90s. We're talking about 6% of the population being banked. 94% excluded. So this is a market we can grow very rapidly, much faster than we grew in Kenya, where we moved from number 66 to become number 1 largest bank in Kenya.
What Equity has done, I think, is one of a first, because Equity has been able to demystify the whole trade across DRC.
Kenya's Trade Chief Administrative Secretary Lawrence Karanja lauded Equity for partnering with the DRC and Kenyan governments for what he termed as part of a greater vision of the Africa Free Trade Area.
Kenya is keen to enhance trade relations through COMESA, tripartite, and African Free Continental Trade Area. And as I've said, we are pleased to welcome DRC into the East African community, because by so doing, we'll be having a market of more than 200 million people within the East African region. That is a market, and I will be asking the people of DRC and the people of Kenya to look at that opportunity which is coming.
We want more of this because it's bringing like-minded people together. What is also the missing link is normally money. How do you de-risk an opportunity? Working with Equity as a partner, we're able to understand off-takers, we're able to de-risk by making sure that the money is available, we're bringing like-minded people together. Equity is a lubricant in all of this. And by facilitating and going at different government levels, we're removing a lot of wrinkles and allowing us to do business. Just love it.
Day-long discussions in sessions in Kinshasa, Lubumbashi, Goma and Bujimai addressed various topics with strong panels of experts analyzing their respective sectors. An exhibition site was annexed to the plenary where traders from both countries also had an opportunity to showcase their products and services. The delegates had an opportunity to network with their Congolese counterparts in matchmaking sessions and business site visits in all 4 cities. Equity BCDC MD Mukeba was at hand to discuss how the entrepreneurs can partner with the bank.
The DRC is a country of opportunity in the sense that the number of population, we are talking about 100 million people, and it's growing at least 3% per annum. So that shows the headroom in terms of growth, especially when we speak about 6% only the banking penetration. So 94% is the potential of growth.
It is refreshing to see that Africans are going to Africa, and we call them same as we call someone else investor. It is a very good thing. I love the mission.
Participants had a chance to interact and appreciate firsthand the opportunities that exist in trade, manufacturing, agriculture, mining, tourism, IT, among other sectors.
This mission is very good because it is also an opportunity for people of Africa to be together for that good business that we need to do between Africas. Equity Bank is now like a medium, between us in our invest.
Kenya's ambassador to the DRC, George Masafu, expressed his satisfaction with the mission.
Kenyan businessmen are not coming here to do business by themselves. They're coming to partner with Congolese partners here. So the bank is also going to finance the Congolese businessmen, just as they're going to finance the Kenyan businessmen. And we believe that with strong trade ties, the relationships between our 2 countries are going to be very strong.
Speaking at the Lubumbashi leg of the mission, Deputy Governor of Katanga, Jean-Claude Kamfwa, thanked Equity BCDC for the initiative to bring the Kenyans.
Je tiens donc à saluer l'implication du groupe Equity Bank et Equity BCDC dans l'organisation de cette rencontre qui, reconnaissons-le, revêt toute son importance comme étape cruciale devant permettre l'éclosion d'initiatives régionales, favoriser les synergies et la création.
Everything in Congo is an opportunity, if I have to say so. Everything is an opportunity. There's no field in this country you can tap in and not get successful. Everything, no matter what you think about. Because just take the population, 100 million. We don't want a market of 100 million customers. It's ready available. You think of agriculture, you think of education, you think of medicine, you think of all the fields are in need in DRC.
Equity Group Chief Commercial Officer Polycarp Igade said the mission has opened doors for Congolese entrepreneurs to visit Kenya.
We come to seek partnership. We come to embrace you, to give you a normal African hug, and to shake hands as equal partners. So we expect that there'll be a lot of business from DRC coming to Kenya and a lot of Kenyan business coming to DRC.
At the opening ceremony of the Goma conference, the governor of North Kivu, General Constant Kongbanima, said the DRC government is setting up economic zones to attract foreign direct investments.
Et vous souhaitez la bienvenue à l'occasion de la cérémonie d'ouverture de la mission commerciale Kenya-République démocratique du Congo 2021. En effet, cette mission organisée conjointement par la République sœur du Kenya et de la nôtre, regroupant plusieurs hommes d'affaires, tant kenyans que congolais, a pour mission la promotion et la consolidation des relations commerciales et économiques entre nos deux États. A conduit cette mission et aux hommes d'affaires kenyans pour le choix judiciaire de la République démocratique du Congo comme destination de prédilection pour les affaires en général et en particulier la province du Nord Kivu.
All things they're selling. Some selling the food, some selling the clothes. You know, this place is the big market from Kinshasa market. It's the #1 market from Kinshasa. In Bizu Bizu Mall, it's the place, many people know the place. So more people can come to buy the clothes and give to the tailor to make. So have more machine, any tailor can come to take it. Before, no have e-banking. For computer, you can send your money. So now Equity open it with e-banking. So e-banking is
Everyone please sit. To be graced with the Central Bank Governor, Dr. Thug of Kenya. He has recently taken office, and I think what he will have to discuss with us will be very enlightening. And I want to turn it over to Dr. Mwangi to introduce him and to take the conversation forward.
Thank you, Joy. Colleagues, friends, as Brent would say, when we do investor roadshows, the biggest question is about economy and microeconomic environment. And it's for that reason we thought we could invite the governor of the central bank to come and talk to us with a very special focus on the monetary policy. I've been very privileged to have known Dr. Thuge for a long time and to call him a friend. Dr. Thuge joined us as a country from IMF, came to Treasury, rose to the rank of the Principal Secretary, National Treasury, so he understands the fiscal policy fully, executed it for many years. In between, I think he held various directorate positions, so he really understands the structure of our economy and how it's managed. And recently, I think 2 months, Dr. Thuge, are they yet 2 months? I think 2 months, we were, as a country, and particularly the financial sector, privileged to have him appointed the governor of the Central Bank of Kenya. And so we have invited him to talk to us about his perspectives of the economy, and then we shall interact with him. We shall have a conversation. He has accepted to answer the questions that you have been bombarding Brent and Yvonne with. So there we are, and without much ado, let me invite Dr. Thuge, the governor of the Central Bank of Kenya, to talk to us. Dr. Thuge, feel free to talk from here or from there, wherever you are most comfortable.
Let me come over there.
Yeah, come from, very good.
Good morning, everyone. And thank you, Bonawangi, for that good introduction. I think what I'll do is just be quite brief. Maybe we can have more time for questions. But I want to cover the several areas, just the growth performance, as well as how we see the growth going forward. I'd also like to cover inflation, where we are in terms of inflation, and what our expectations about inflation, a bit about the financial sector and how stable it is, and then conclude on something about the payment system and where we're going with the payment system. And so with that, our economy is quite resilient. It has been one of the fastest growing economies in sub-Saharan Africa and indeed the world. And this is despite some fairly strong shocks recently, including the COVID-19, and of course more recently the ongoing war in the Ukraine. And I think this resilience stems from the fact that our economy is very diversified. If you look at the shares of the various sectors in the economy, you see that agriculture, for example, comprises about 22% of nominal GDP. And then the second largest sector is transport and storage, which is about 12%. And then you have a bunch of about 3 or 4 sectors that comprise about around 7% of GDP, and that would include manufacturing, includes finance and insurance, and also includes the manufacturing and also real estate. So what happens with such a diversified economy is when one does not perform, others do, and I think that's why we've been able to sustain fairly robust growth over quite a long period of time now, over maybe the last decade. I think this is borne out by, for example, last year the economy grew by 4.8%, and this was in the context of a contracting agricultural sector, which contracted by 1.6%, but nonetheless we were able to record a growth of 4.8%, which was much higher than the global average of 3.4%, and also much higher than the sub-Saharan African average of 3.9%. I think going forward, we expect the economy to continue to grow quite robustly. Already in the first quarter, it grew by 5.3%. And really, we do expect the growth to be at least 5.5% this year, driven by the recovery in agriculture, which has shown signs of a recovery even in the first quarter, grew by 5.1%. And we expect it to grow by at least that level for the rest of the calendar year. And so we are quite hopeful and expect real GDP to maintain its recent growth momentum. On inflation, of course, most countries around the globe have experienced rising price levels, and they're mostly supply side. Either for us, it has been because of obviously fuel prices have gone up. We've had these supply chain disruptions, and of course, we've had a drought for the last 3-4 years, and all that has put pressure on food prices, has put pressure on fuel prices, and some of that has spilled over to the non-food and non-fuel prices, which are now averaging about 4%, compared to just a year ago when they were roughly below 3%. And we believe that that even as we address the overall rate of inflation, which is now about 7.9%, that we must also address very strongly the core inflation, which is the non-food, non-fuel. And part of the reason we took some very strong monetary policy action was actually also to make sure that we anchor inflationary expectations and also try to address the component of inflation that is subject to monetary policy, because obviously fuel and food prices are less responsive to monetary policy changes. So again, we've taken the position as a central bank that we are going to be quite aggressive in terms of addressing inflationary pressures, and that's why we increased the CBR rate by 100 basis points, which was quite, in a sense, that was also catching up with some of the increase in interest rates that have happened in other countries. For example, the US. The US has raised their policy rate by 500 basis points. We had only raised ours by 250 basis points. And so there was a bit of difference in yields and returns. And that also tended to put some pressure on the exchange rate. On the issue of the exchange rate, we of course pursue a flexible exchange rate system, and we sometimes intervene, although we have not been intervening very much recently, but we intervene when we think that there is excessive volatility in the exchange rate. Otherwise, we allow the exchange rate to find its own level, basically through demand and supply. Of course, as I said earlier, we've had some pressures recently, especially the last 1 year, and that basically stems from the fact that the US, especially the US, tightened monetary policy very rapidly and very strongly, and that caused interest rates in the US to rise and to exceed our interest rates, and that did cause our exchange rate to depreciate, and indeed not only our exchange rate, but most currencies in the world weakened against the US dollar. Now, going forward, we suspect that as the US slows down on monetary policy tightening, that the pressures on the exchange rate will reduce. And also the fact that looking at our balance of payments, we see an improvement in the balance of payments. The current account now is roughly 4.8% of GDP. It was a bit higher at the end of last year, but we see a fairly robust performance in our exports. Tourism is also doing quite well. Remittances also remain quite strong. And on the import side, we see a deceleration in the growth of imports, mainly because fuel prices are a bit lower compared to last year. And also the fact that a lot of the infrastructure, government infrastructure projects have been completed, and therefore there's less need to import machineries. So we do expect that by the end of this year, the current account deficit should narrow to below 5%, and roughly we are estimating it to be about 4.8% of GDP. In terms of the international reserve, we have reserve cover of 4 months of import cover, which is basically consistent with the CBK's statutory requirement. So let me just add again from the point of view of the balance of payments, our capital account is fully liberalized. We don't have any controls on movement. So let me just say something regarding the financial sector. Our financial sector is the largest and deepest and most diversified in the region. And as a reflection of the stability in the banking sector, our capital adequacy ratio is around 19%. And this is compared to the minimum statutory requirement of 14.5. And similarly, when you look at the liquidity ratio, ours has been hovering around 49% compared to a minimum statutory requirement of 20%. With regard to non-performing loans, there has been some increase compared to last year. Last year, at the end of May, we had non-performing loans of 14.1%. By the end of May of this year, that had increased to 14.9. However, we do expect that number to decline, partly because one of the reasons why the NPLs went up was that government was not, both levels of government, the national government and county governments were not paying their suppliers, and that led to an increase in NPLs. Now, towards the end of the last financial year, there was a lot of liquidity that went to the government. We had $1 billion of disbursements from the World Bank that came in, and we also issued an infrastructure bond that generated a lot of resources. All the county governments were paid all their monies, all their equitable share, and therefore we do expect that this number of 14.9 should actually start to go down. In terms of the profitability of the banks, we have seen banks continue to make a lot of profits. I think up to May, we estimated that there was a profit of 100 billion shillings, which is about the same, just slightly lower than that at the end of last year. We've also seen an increase in banking sector credit to the private sector. And this is for us, is a very interesting area because for a long time, since about 2016, when the interest rate cap was introduced, credit to the private sector from the banking system was very, very low. It used to average, sometimes it would be 4%, 2% per year, and then it stabilized around 7% for quite a number of months. And then beginning last year, around March, I think we saw the first time when credit to the private sector actually achieved double-digit growth. And that growth has been maintained at double-digit since that time. And we hope that this will continue. There used to be a time, some time ago, when credit to the private sector used to average about 20, even 22% per year on a sustained basis. And I think that is when we used to hear there's a lot of money in the economy compared to the last few years where even as the economy recorded growth of 5 to 6%, you still had people complaining that there was no money in the economy. And I truly feel that part of that feeling can be explained by the fact that the banking sector credit to the private sector was increasing at a very, very low rate. And in fact, if you look at credit to the private sector relative to GDP, there's been a consistent decline in that ratio over the last 6 years. It used to be like about 34% of credit to the private sector relative to GDP, and I think now it's 26%. It's just been on a downward decline. So I'm glad to see that there's been this turnaround in credit to the private sector, and we do hope that that will continue. And I think it will continue because I'm sure the Treasury will come and speak to you a bit later. But if you look at the Treasury's plan on fiscal consolidation, you'll see that they are reducing the fiscal deficit this year to 4.4% of GDP from around 5.8 last year. And I think with that kind of fiscal consolidation and continued reduction of the fiscal deficit, we should be able to see less borrowing by the government from the banking system, and therefore crowding the private sector, and also put down pressure on domestic interest rates. So just to make the observation that Kenyan banks have a huge footprint in the East African region, and here we have expanded quite significantly. The number of branches of Kenyan bank subsidiaries has increased from 494 in December of 2021 to about 552 in December of 2022. And of course, Equity Bank has been one of the key players in that expansion. Just a couple of other things on the issues of climate change. We're very aware of the need to address issues on climate change, and we have issued to the banks a guidance note on how to address climate risk management, and basically in terms of the governance, in terms of the strategy, sort of risk management, and ultimately in terms of the disclosure frameworks. And we did this with the idea that this is also a new opportunity for banks to engage, and where they can engage in terms of mitigation and adaptation to climate change. On the issue of anti-money laundering, again, here we are very determined to address issues on anti-money laundering and the combating of financing of terrorism. We did our own assessment in 2021 under the National Risk Assessment. Last year, we had the East and Central Africa Anti-Money Laundering Group came here. They did a mutual evaluation. And arising from those two reports, we have identified some of the key deficiencies that we are now in the process of addressing, and designing an action plan so that we address all those issues. On the payment system, I think the only thing I'd like to just mention on the payment system is that, of course, we have the East African payment system. We also have the COMESA regional payment and settlement system. But we also want to express our interest in hosting the Pan-African payment and settlement system. And we will soon be writing to Afri-Eximbank to express that desire. And I think as we move towards the African Continental Free Trade Area, we should position Kenya and Nairobi as the financial as a financial hub in this particular region. So I think maybe just to summarize then, that the central bank is very committed to maintaining macroeconomic stability, and I think the fiscal and monetary policy are now aligned and moving together. We are obviously concerned about the issues of debt, but I think with the planned medium-term reduction in the fiscal deficit, we should be able to see the debt reduced to sustainable levels. The level we are targeting is 55% of net present value of debt to GDP, and that we should be able to achieve by around 26. So again, just from our end, we believe that a stable macroeconomic environment is perhaps the most important foundation for investor confidence and for rapid and sustained economic growth. And we in the central bank intend to sustain it. Thank you very much.
Thank you very much, Central Bank Governor, Dr. Thuge. I think you have been very candid, very upfront. Most likely you have answered a lot of questions. Thank you for data, sharing without data. Governor, we thought today maybe I may not be able to be the best person to engage you a little bit on a conversation. And we have asked our chief economist and director of research, who you might have known before she was the African chief economist of Renaissance Capital, to maybe try on our behalf explore a little bit of your conversation, and maybe from a practitioner's point of view, try to frame maybe our views and see your responses. Then we get back to the audience with a couple of questions. Over to you, Yvonne.
Thank you, James, and thank you, Governor, for joining us. It's a pleasure to have you here and for you to hear you share your views on policy going forward. First, I would like to commend the Central Bank for the 100 basis points hike we saw on the 26th of June. We do agree that a catch-up needed to be made on the interest rate side, given the 500 basis points hike we saw in the US. We fell short of that. We thought there was room for some hiking to take place. So it is promising to hear that the Central Bank is taking a more aggressive stance on policy going forward. You also mentioned when you spoke, though, that when it comes to monetary policy, the limitations on what monetary policy can do for variables such as fuel and food and what it means for inflation. So my first question then is around inflation, which seems at this point in time to be sticky at around the 7.98% region. My question to you is, where do you see inflation in the short term, and in particular, when do you see it falling back into the target band of 2.5 to 7.5%?
Can you hear me? You can hear me? No. Okay. Yes, it's indeed the rate of inflation had accelerated to about 9.6% through October, and then since that time, it has kind of trended downward. In June, it reached 7.8, and the month before it was 8%. Now, what we expect is the information for this month, for July, is likely that we may not be within our target range or below 7.5. And that may be explained in part by the fact that there are some adjustments, especially on fuel, that have happened since over the last month, or indeed this month. So we don't expect the inflation to go below the 7.5. However, we have seen indications that food prices could be coming down. There are indications that the harvest and the food production will be quite good in the next 2 to 3 months. And therefore, we do expect the food inflation component of the CPI to decline substantially. So maybe by September, October, we would expect that as food prices come down, then the overall inflation rate should now come within the band and below the 7.5. That's generally our expectation.
Okay, thank you. My second question is around the external balances, particularly the current account. You mentioned that I think the year-to-date current account deficit looks as though it's going to be smaller than it was last year, and that's, of course, on the back of a smaller import bill. However, we've continued to see foreign exchange reserves fall, which I guess implies that there's at the same time a slowdown in foreign financial inflows. My question is, what do you expect that trajectory to be over the next 12 months? And what does that imply for the reserves position as well as the currency, in your view?
I think on the issue of the currency, as I said, there was some significant depreciation of the currency in the last 12 months. We think that is now slowing down, and also helped by the measures that we took the other day to raise the interest rate. I think on the foreign reserves, we obviously we will continue to access the markets, global markets. We, as I said also earlier, with the current account also improving, we expect an overall balance of payments surplus. So really, we don't expect forex reserves to decline or to be below where they are now. And as you know, it's actually a statutory requirement that we maintain the 4 months of import cover. And I think we will be trying to maintain reserve coverage at that level.
Thank you. At this stage, I'd like to ask if there are any questions on the floor. I don't want to monopolize the governor's time. There's a question here. Mike, please, yeah.
Thank you. This is Ronak from EFG Hermes. Just as a follow-up to the FX discussion, excuse me if I'm incorrect about this because there's not much data available, but anecdotally from what we hear from stakeholders, it seems the interbank market is not yet fully functional. Could you comment if that observation is correct? And if it is, what measures could be taken to further normalize the situation? And the sort of as a follow-up to that as well is, you just mentioned that you don't expect FX reserves to drop below the 4 months import cover. Is that even after considering the G2G deal that the government has implemented with various MENA-based oil companies? Thank you.
Another question maybe, so the governor can answer too. There's a question here.
Thank you. Wesley Manambo from Jengis Capital. From your regulatory standpoint, what's your view on shifting the banking regulatory for Kenyan banks with significant regional presence to DSIBs? That's domestically systematic important bank with a view of narrowing down on cross-border risks. Also, from the macroeconomical aspect, looking at the economy 2023, we saw that in as much as the quantum of imports went down, the value spent went high. So it implies, especially when looking at the core inflation, most of this is externally driven cost-push inflation. From your playbook, what measures will you execute to really control the externally driven cost push inflation? Thank you.
The third question, yes.
Yes, Davis from Sterling Capital. Just a follow-up to his question. So, given that to a large degree inflation has been a supply-side phenomenon driven by the rise in input costs, commodity prices, etc., and then you have that, the response to that has been increasing interest rates, and on the other side, government increasing taxes. Now, is it a correct observation to make that the dual impact of this will basically be a reduction in output on the whole? So, for example, KRA numbers that came out yesterday, beer and tobacco taxes have only been up by 0.4 and 2.8% respectively. So you're having a Laffer curve effect of sorts, whereby consumption is being killed. Is that a correct observation of the dual impact of these two events? Thank you.
I think we can take that, Governor. And if there's time, we can take another couple of questions.
All right, I think let me start with on the issue of the interbank market and it not fully functioning. I think certainly there was a time, even earlier this year, where the interbank market was not functioning. And we did see some fairly huge spreads between the central bank rate and also the retail rates. But I think since March, with the issuance of this code that we issued to the banks on the foreign exchange market, we've actually seen the market, the interbank market, working a bit more than it was before. I think there's still some ways to go, and I think this is one area that we will need to engage really with the commercial banks to see how really we can increase activities and trading within this interbank. We are not there yet. I agree with you. We are not there yet, but it's something that we are working on. And we can see some success in the sense that now, if you look at the spread between the central bank rate and the retail rate, it's not as high as it was before. I think before there were times when there was 8 shillings or even up to 10 shillings difference. But now you just see maybe 2 or 3 shillings as a difference. So there's some work to be done there, but I think we're making some progress. On the G2G, the 4 months import cover does take into account the G2G. Of course, it's important to note that any foreign exchange that will be required either to later pay the oil from the Middle East, that will come from the banking sector. So it will not be so much coming from the international reserves of the central bank. On the issue of inflation and measures to execute, given this is cost push inflation, I agree that this is supply side, mostly has been supply side inflation. However, I did also indicate that even when you look at the core inflation has itself also accelerated. And when last year, when we were operating within the range, when overall inflation was around, let's say 5%, core inflation was anywhere between 2 and 3%. But since that time, even in June, the core inflation had increased to 4.1%. So there's still scope for using monetary policy to address that part of the inflation that can't respond to monetary policy. But it's also critical that we address the issues of expectations. And this action we took, yes, it may not lower food prices and it may not lower fuel prices, but at least it will send the signal that we are not going to entrench high inflationary expectations in the economy. And so once those food prices and fuel prices come down, then we should be able to really see a significant reduction in inflation. I don't know whether that also addresses the issue on the increase in taxes and the increase in interest rates and whether that is having a negative impact on revenue collection and whether we are at the Laffer curve. What I would say is on the issue of taxes, we are already concerned about the high debt ratios that we have. And right now, I think the debt to GDP is almost 70%, 68, 69% of GDP. And that's just nominal debt. In terms of the net present value, I think we are about 62, and we are aiming to go to 55. But we can only do that if we mobilize resources. I know sometimes we think that there's a lot to cut on expenditures, but you'll be surprised to know that if you just look at the debt service, and leaving aside the domestic debt, if you look at just the interest payments on domestic debt, interest payment on external debt, and then external debt amortization, you see it may come to around maybe even 1.2 trillion. That's just on debt. Then you add salaries. Yeah? Salaries are probably somewhere maybe 800 billion. Yeah? Let's say it's 800 billion. You add the two, you're already at 2 trillion. Yeah? And then maybe add another 400 billion to county governments. Yeah? You're already at 2.4 to 2.5 trillion. Yeah? And that's the ordinary revenue you're actually targeting to collect for this year. So so it leaves very little else to run the activities of the government. So in my view, this idea of fiscal consolidation, which we must have, and we must have it to reduce our vulnerability to all the issues that high debt ratios raise. It has to come from revenue mobilization. I think there's very little room for sharp expenditure cuts, and we don't want to cut development expenditures. So it's really important that we do mobilize revenues so as to reduce our borrowing and stabilize our debt going forward. And of course, on the end, let me also say that even as we now raise those taxes, it does, as I said earlier, it does reduce government borrowing from the domestic economy. It crowds in the private sector. It reduces pressure on interest rates. So that also in itself can also drive the economy. And right now, as we see an expansion of credit to the private sector from the banking system, I think having that fiscal consolidation driven by mobilizing domestic resources is actually in the right direction. I think on raising interest rates and addressing inflation, again, in my view, I think having a stable macroeconomic environment is critical for growth. And therefore, as we raise interest rates to, just to address inflationary pressures and to arrest the depreciation of the exchange rate, those factors would also contribute, I think, significantly to investor confidence and therefore increase in investments and also improve consumer sentiment.
Central Bank Governor, I trust you have an hour with us. Can I take it that way? Thank you very much. I said this because just Sin walked in PS Treasury, and it will be very good to hear. We have had the monetary policy, the fiscal policy, and then hopefully the next question can come when we compare and contrast the two. So that's why I thought if we could stay a few or more minutes, we could call in PS Treasury, represented by Karen Kadir, the Director, State Parastatal Reforms. It's very interesting. So we'll cover the subject of fiscal and then talk a little bit about the reforms. Without much ado, I give the podium to make your presentation, and then you join us. We'll give you the podium. And then you can join us here to take a few questions and see whether we can reconcile and agree on monetary and fiscal policy. It's a very good position to be in. Madam Kadir is started in banking. Those who know, she was the managing director of IDB, Industrial Development Bank, and then went to Treasury to spearhead reforms. I saw her over a weekend and only learned then that she's on her PhD, I hope in financial and monetary issues. So, Kadir, for you. Thank you.
Thank you. Thank you. Representative of Cabinet Secretary for Investment, Trade and Industry, the Governor, Central Bank of Kenya, Dr. Kamau Thuge, Dr. James Mwangi, Equity Group Managing Director and CEO, Equity Group Directors and top management, government representatives and development partners, industrial leaders present here today, distinguished guests, ladies and gentlemen, good afternoon. Please receive warm greetings from Dr. Chris Kipto. He asked me to represent him here, but he sent his warm greetings. It is my great pleasure this afternoon to address this gathering that brings together great minds drawn from the government and industry players. This session provides an opportunity for us to reaffirm that Kenya is indeed ready for business and that we mean business. Our economic outlook presents a bright future that casts a cloud of hope to the Kenyan people going forward. In 2022, the economic growth slowed down due to the adverse effects of the multiple shocks that we are all aware of, which included the lingering effects of COVID-19 pandemic, the disruption of supply chains after the Russia-Ukraine conflict that continued to affect the global commodities prices, and the impact of climate change. Kenya's growth in 2022 was supported by positive growth in all the services sectors, including manufacturing, construction, as well as electricity and water supply sectors. During the year, agriculture sector contracted due to unfavorable weather conditions and drought. The economy is expected to rebound and expand by 5.5% in 2023 into the medium term. We seek to achieve this growth trajectory through broad-based private sector-led initiatives and interventions towards the recovery of the agricultural sector. This growth outlook, ladies and gentlemen, will be reinforced by interventions being implemented by the government under the bottom-up economic transformation agenda, now called BETTER. The BETTER model seeks to increase investment in at least 5 sectors, namely agriculture, SME, housing and settlements, healthcare, and digital superhighway. These sectors are envisaged to have the largest impact and linkages to the economy as well as on household welfare and livelihood. The government will also continue to support economic recovery by pursuing prudent macroeconomic policies towards reducing debt vulnerabilities and supporting sustainable and inclusive development. Inflation rate has remained well above the upper bound target since June 2022, mainly due to high food and energy prices, following adverse weather conditions, and high global oil prices. We are working closely with the Central Bank of Kenya, represented here, through the Monetary Policy Committee to put in place monetary policy measures to tame inflation. We have already seen reduced inflation measures with the month of May 2023 recording 8% as compared to, for example, 9.6% in October 2022. Ladies and gentlemen, in the fiscal front, the National Treasury is spearheading the process of putting in place a robust national tax policy framework. The framework is expected to enhance administrative efficiency of the tax system, provide consistency and certainty in legal registrations. We are also working closely with other government departments and agencies to address the legal and other fiscal policy issues for the facilitative industrial zones programs like the special economic zones and export processing zones. And the government, under the stewardship of the State Department for Investment, is working towards reforming all the business-related legislations to address the plight of investors. Ladies and gentlemen, for us, therefore, to achieve the desired economic growth as per our plans and projections, we need to work closely with the private sector as the key drivers and catalysts of economic growth. The National Treasury and the government at large seeks to tap into the opportunities presented by the public-private partnerships. The global financial crisis and other shocks experienced in 2000 have seen renewed interest in PPPs arrangements by both developed and developing countries. The shrinking public resources and fiscal space, coupled with the inevitable need to invest in infrastructure development, has seen governments turning to the private sector as an alternative source of funding and also ideas. Kenya has made very good progress on the infrastructure agenda covering roads, rail, energy, ports, water, and sanitation and housing. We have supported these initiatives through strong medium-term policies to ensure we continue on that trajectory in a sustainable manner in order to drive efficiency in the delivery of public goods and in an effort to achieve optimal allocation of scarce resources between infrastructure and social services. The government of Kenya has adopted a private sector-led growth strategy in the development of sustainable and high-quality infrastructure. Ladies and gentlemen, in the past, PPPs in Kenya were regulated through contract, and this enabled the emergence of PPPs, which were largely limited to the energy sector. With this experience, the government made a strategic decision to mainstream PPPs in public finance by adopting a structured policy and regulatory framework through the enactment of a PPP-specific law. Following the enactment of a PPP-specific legal regime in 2013, the government has managed to mobilize over $1 billion in private funds channeled into public infrastructure projects outside the energy sector. One of the iconic projects delivered is a 27-kilometer Nairobi Expressway project, which we are all familiar with, which was meant to ease traffic and reduce congestion in the CBD. Several other commercial contracts amounting to over $3 billion in various sectors have been signed up. Ladies and gentlemen, in order to sustain the momentum The government revised the legal and regulatory framework for PPPs through the enactment of a PPP Act in 2021 to accelerate the delivery of PPP projects. Some of the key measures adopted in the new law include 1, creation of efficiency through reduction in the number of regulatory approvals from 12 to 3 without compromising governance, accountability, and transparency. 2, entrenchment of procedural predictability and certainty through stipulation of timelines for key PPP steps throughout the PPP project development cycle. 3, expansion of available PPP contract models from 13 to 17, and PPP procurement methods from 2, that is competitive procurement and privately initiated proposals, to 4, through the inclusion of direct procurement and restricted tendering. Besides this regulatory initiative designed to give impetus to the PPP program, the government has also made a deliberate effort to establish strategic linkages with bilateral and multilateral partners to explore opportunities for collaboration on public-private partnerships. Ladies and gentlemen, I wish to turn my attention now to the financial sector. Kenya has one of the most developed financial services sectors in the continent. We arrived for the establishment of an international financial center in Nairobi to attract global financial players. Nairobi is a fintech hub, nicknamed the Silicon Valley for Africa amongst emerging economies, recording impressive growth in innovative digital financial products and services like the M-Pesa program. To continue to reinforce this strong position, we are working with organizations such as the Financial Actions Trust Force to ensure Kenya fully complies with the relevant international standards on money laundering and terrorism financing to make this international financial center a reality. The Nairobi International Financial Center Authority is in place and fully operational. The center seeks to not only prioritize attracting financial and investment into infrastructure and development projects, but also attracting green finance for sustainable economic development and growth and investment into fintech and new areas of innovation, building on the emerging fintech ecosystem. The Nairobi International Financial Center operating environment is also tailored to be conducive for global financial and professional services firms that want to establish their regional headquarters in Africa and to be efficiently and conveniently done in Nairobi. In another front, the doing business reforms have registered significant progress in the recent past, with the government making great strides towards digitizing all services. Through these and other initiatives, Kenya was ranked #1 globally under the Access to Finance indicator of the World Bank Ease of Doing Business 2021 ranking. In conclusion, ladies and gentlemen, I wish to underscore that the private sector plays a critical role in realizing economic prosperity by creating employment opportunities and through the delivery of critical goods and services and a contribution to tax revenues that support provision of public goods. To this end, we are committed to improving the trade and investment environment through facilitation and implementing key policy initiatives. Finally, I wish to thank the Equity Group and Dr. Mwangi and his board and management for inviting the National Treasury in this engagement. Thank you, ladies and gentlemen, for your kind attention.
Thank you very much, Colin. We are really grateful that you were able to join us. And maybe what you may not know, you have linked up the presentation we had last night from the American ambassador. And the focus from her was why Kenya? And broadly, it's like you were reading from the same script. And fortunately, you were not in the room when the governor presented. And one would have thought you shared the presentations about the economy and what need. And maybe what us in the financial sector are noting is the coherence between the monetary and fiscal policy. And one of the questions that seems we have been asking ourselves is why an expansionist policy, not austerity measures. But today you have explained to us that there is no headroom for budget cutting and austerity measures. It's a revenue issue. So it seems that the governor has really helped to understand the finance bill and put it in perspective, given the state of the economy. But also linked to the recent carefree, Brent seems to, with the African Recovery and Resilience Plan of Equity, it's almost a mapping of the national strategy with a focus to the real economy. It's all about the real economy is about the role of the private sector. And that is what gives us a lot of confidence and really are able to appreciate what the American ambassador sees in Kenya taking a very bold step, because there is alignment between government, there is alignment with the private sector, there is recognition that the private sector would play the critical role. And for the private sector, it's all about stability in the monetary policy. It's macroeconomic environment stability. It's about the government spend being in the real economy. And that is the coherence we are seeing. And I think I couldn't be more grateful than to have Treasury and Central Bank sitting next to each other and availing them to you if there are any questions that you need to clarify. Very good.
Yeah, Justin Mwangi from SBG Securities. So just 3 quick questions cutting across the three dockets. So the first one is on just capital adequacy for Kenya. This is to the central bank governor. We have seen movements by central banks in the region to increase the minimum capital requirement. Uganda last year to about $30 million. DRC is doing something similar to $50 million in the next few years. TZ the same. Is that something that you think is necessary in the current environment for Kenya, given the change in macros? And we are at $10 million minimum for the sector. The second one is on sort of the Eurobond impact. This is maybe CBK or the Treasury impact on the debt levels that we have next year, as well as the impact on FX reserves and currency performance. Then lastly, just touching on the country plans that Dr. Mwangi mentioned a bit earlier. What are, maybe briefly, are some of the initiatives Equity is carrying out with the Kenyan government at this point that you think is important for you to share? Thank you.
Thank you. The next question. The other question. Very good, right there.
Yes, hi. My name is Michael Odundo from Standard Investment Bank, and my question touches on anti-money laundering, because we saw that lawyers and the government were in a stalemate whether or not that lawyers should whistleblow on illegal funds. And so my question is whether this stalemate was sorted out, given that there's a risk of the financial sector being grey listed. Thanks.
Thank you. Another question before we give the opportunity to answer them? Yeah, very good. There is a question here.
Yeah, my question again to the CBK governor. You mentioned in your presentation the NPLs for the sector. Hello? Oh, okay. Yeah, so the sector level NPL ratio is 15%, which seems quite high. You did indicate that you're expecting it to reduce. Sorry. So you did reduce, but the absolute NPL ratio remains quite high. Is this something of a concern for you? And are you planning any remedial action to try and understand the scope of the problem and maybe try and get a solution to bring it back to more normalized levels? Thank you.
Thank you. Maybe Governor and Director, we will allow you to select the questions that are aligned to your office, and then we can see whether there will be another round of questions.
Okay, I think with regard to the first question on the issue of the minimum requirement and whether we are going to raise it, it's not something that is on the table now, but I think I'm also on record publicly saying, in my view, I think maybe we have too many banks, and that we should look into ways as to how we can encourage more mergers and reducing the number of banks. I mean, I said that during my vetting in Parliament, and it's something that I would like to pursue and look into. On the issue of the Eurobond, maybe also Treasury can chip in. The debut Eurobond falls due on, I think it's June 24th or something like that of next year. I think Treasury now is in the process of trying to get a lead manager, basically to advise on how to do the liability management. There are several options, one including perhaps even taking out some of it before the end of this year, and there are resources that have been identified that can be used for this purpose, and then, then whatever remains next year, we can do now liability management next year, presuming the sentiment then will allow. I think right now the yield on on that 2024 bond is, I think, roughly 12.5. It's quite, I mean, it moves up and down. I think maybe a month and a half ago, it was almost 19-20%. It's come down. So also, I think if we do some of these things that we are doing, with the fiscal consolidation I mentioned, stabilizing the exchange rate and basically stabilizing the economy, I would expect those yields to come down to reasonable levels where now we can do now the liability management. In terms of debt levels, I don't think at least it was envisaged anyway initially that you would just do liability management by issuing another Eurobond of the same amount. So obviously that does not affect the debt levels. But for foreign exchange, obviously, if we do beyond the Eurobond, then of course we'd get the foreign exchange. But if we're just going to pay off the 2 billion by doing liability management, that will obviously not have any impact on the foreign exchange. But I think the bottom line on the Eurobond is that it's very clear in our minds what we want to do. And I think foreign investors should not be concerned that somehow we will not be able to deal with the Eurobond and not be able to take it out exactly as as was intended. On the issue of the anti-money laundering, yes, it's true. One of the sticking points was the issue of lawyers as being reporting persons, and the issue has not been resolved yet. We have been engaging with the Kenya Law Society to see whether we can have some kind of an agreement or compromise, but those discussions are continuing and are ongoing. On the issue of the NPLs, yes, we are concerned about the NPLs. I think we'll get a clearer picture, once the liquidity I mentioned, since counties are now fully funded, government also got a lot of money. Let's see where the levels stabilize. Of course, we've also engaged with the banks to just make sure that they're also looking at this and they are provisioning they have the right provisioning for those NPLs. But it's something that we are keeping a very close eye on. I think those are the questions.
Thank you. Thank you for the questions. I think Dr. Thuge has ably addressed almost all of them. Probably just I mentioned the Eurobond, which is maturing in June 2024. And there's already a program, as you may have seen, the PS was in London about 2 weeks ago to meet the investors. So a program has already kicked off 1 year in advance to make sure that the Eurobond is handled properly and we are comfortable and the investors are comfortable with how it is handled. So let's all stay confident that Eurobond is not a problem. The other one I would probably just touch on is on anti-money laundering and whether lawyers should be whistleblowers. Whereas maybe that discussion, the encouragement is that anti-money laundering affects all of us, especially professionals. So we should all team up to make sure that as a country, we are known as a country which has zero tolerance to anti-money laundering and anti-terrorism financing. Thank you.
There was a question on partnership with government in terms of rolling out the African Recovery and Resilience Plan. Ideally, the plan is for East and Central Africa, but we have been able to customize the plan to each country, such that there is a country-specific plan which we have aligned with the national plans, including budgets. And that's why if you look at the areas of focus for the plan, there is a complete overlap with what the government and the bottom-up or the better strategy is focusing on. But there are technical areas and maybe operational areas of collaboration with the government a lot, like what the governor of the central bank said when it came to the Forex interbank. We have worked together, it has been revived, and we can see the volumes have gone up almost to 40% of what they were at that time. The areas, for instance, today, here is Treasury, central bank, and private sector. We are trying to give investors a common face as actors in the country. So you can see the huge collaboration. And if we were there last night, you had like the marketing of the country or the road shows to investors. I was representing the private sector, the ambassador was representing the American interest, and we had two ministers with CSs with us. So we are doing, and we are doing the same, as she said, in California and Chicago in September. So they're joint efforts because it's the citizen people, it's a government of the people. So the private sector comes in handy. I see, for instance, a partnership between us and the government, where the KfW, or the German Development Agency, comes in and say, would like to do irrigation, to support farmers and do irrigation, but we would like to do them through the private sector. So the arrangement is done by the government, but the money comes straight to equity, and together we have been able to do 24 irrigation schemes. So essentially you could see, or like what we discussed earlier in the morning, the health sector, the intervention that equity is bringing a nationwide infrastructure of health, high quality, affordable health clinics is to complement the universal health system of the government. So there's quite a lot of partnerships and collaboration, and we in the private sector are really grateful. The government has embraced and appreciated the role the private sector can do, and we appreciate the policy interventions that government has had to make to enable the private sector to really be able to support. So there's quite a lot of examples we could give. Is there another set? Yes. A mic here. And another mic there. You can start there. Yeah, go fast.
Hi, my name is Mark Kotani from swalanyeti.co.ke. Probably my question is to the CBK governor. In terms of looking at what Equity is doing in DRC and probably the other countries in the region, and especially on DRC, what is the government and CBK doing, especially to promote that kind of expansion of Kenyan companies to the other countries in the region, with DRC in mind, with Rwanda in mind, and the others, so that more companies are able to do probably what Equity is doing in DRC?
Okay, can you hear me? Okay, so just given the sticky nature of inflation, given by the fact that it's cost push, and also that the aim with the rate hikes is to drive capital in, so just to fund that capital account, will the CBK aim to keep interest rates higher relative to other countries, just given the opportunity cost? So if we use 2011 as a reference year, interest rates globally were at 0. However, currently, you have the Fed's fund rates terminating at around 5%. So is the aim to wait until the Fed pivots to a lower interest rate regime and keep that capital flowing in by keeping our own interest rates higher for an extended period of time? Thank you.
Another question. Governor, I think the question is really interest rates. Another question. It's not every day you get the treasury and, yeah, and let's help us here. Yeah.
Check. Thank you. My name is Bala from Bloomberg News. I just want to get the central bank governor's sense of the banking industry. You mentioned there are too many commercial banks. I wonder what options would you have on the table to get to the right number of banks that you would want to have in this market? And if you're able to say what size would those banks be for this economy? Thank you.
Those are three questions, maybe. Central bank, treasury, over to you.
I think on the first one, I think so far, and maybe Mwangi can also chip in. I think so far the CBK has been quite supportive of expansion of banks into the region, and as I mentioned, I think earlier, the number of branches has increased, I think from 494 to 552. I think they are actually in every single of the EAC countries. I don't know what else we can do to support that, but maybe Mwangi can say something on that. I think on the issue again of inflation and whether we will keep interest rates high, I think in my view, I think as was mentioned earlier, you know, the US raised their interest rates very rapidly and very quickly and by 500 basis points, and we were we were a bit slow. And so I see it, so to a certain extent, capital moved to reflect those interest differentials. I think going forward, our interest rate policy, the central bank's CBR will be determined by inflation performance. And so as long as we feel inflation has not been fully addressed, we will tighten. But come September, and we feel now the overall inflation has come down, food inflation has come down, the core inflation is also moving towards the direction of the 3% that I mentioned. You know, then we can revisit whether we might even lower the CBR. So I think for us going forward, it will be looking at the inflation performance, and that I think will determine the direction that we will take regarding the CBR. On the issue of the size of the banking industry and what is the right number of banks, and I don't have an answer to that yet. But as I said, it will be something that we will be, you know, thinking about, and ultimately we'll see where that goes. But I can't, you know, tell you right now what the optimal number of banks will be.
Thank you. Thank you very much for those questions. I'll just address one asked by Mark about the DRC. And in this, I would like to very much congratulate the Equity Group for your very successful entry into the DRC market, kind of front runners and trailblazers, showing the other business community that DRC is a viable market. As we are all aware, DRC is now a member of the East African community, and that's one step forward towards promoting more Kenyan businesses to go to DRC. Kenya is also very strongly involved in the peacekeeping efforts in DRC. So I think it's really the Kenyan private sector to aggressively follow the footsteps of Equity Group and the other businesses that have gone there and explore new grounds. And I believe this is one of the areas that private sector succeeds in. Private sector is good into going to more risk and all that. And then if there is need for government to intervene, then you may ask the government to intervene on specific areas. But right now, I think DRC is open for business for Kenyan business people. Thank you.
Let me add there, because we have been very big beneficiaries, particularly from central bank. And if I just quote what the governor said earlier on, is that they're in discussion with African Exim Bank to sign the African payment system. You can imagine what that would do for equity once we have a regional African-wide payment system that enables cross-border trade. So that ability. The second aspect is engagement with the central bank. We, in the last couple of years, or maybe 4 years, we are buying the third bank in Rwanda. We have really been facilitated and enabled through approval. The approval process have been very, very efficient. It's like working together with the government to enable the private sector to thrive. But as Treasury Representative Karen said, when we took 300 investors to DRC to go and explore opportunity and show them what we had discovered and encourage them. We had the 2 ministers with us. And for the 2 weeks that we were in DRC with 300 Kenyans, we were with the Kenyan ambassador to DRC every day. He went with us, therefore, you can't ask more from a government or in terms of enablement. You are working together, you are walking the talk. But it's the presence today of Central Bank and Treasury here, and also the commitment that we'll have the CS finance for dinner that shows the partnership that has evolved in this country between government and private sector. And lastly, is the central banks continuously reviewing and reforming the governance structures. So if you look at the evolution of the governance structures because of regional expansion, the central bank has kept pace and helped us to ensure we strengthen our governance structures. Last week, we had the Director of Bank Supervision in Uganda spending the entire week here, saying, you seem to be ahead of all the banks in the region, can we copy what? And he said, looks like you have worked very closely with the central bank. I think they had initially gone to central bank. So essentially that partnership is what has helped to strengthen the banks in the region and maybe produce second, if not second best banking industry in the African continent. Another question from that side, so you don't say you had ever denied a chance before we come here. Another one on that side? No, this side? Very good, let's come here.
Thank you. My name is Ronnie Choka from Genghis Capital. I do appreciate both the fiscal and monetary agents for making their time to join us today. More to the cross-border payments and settlement system and the conversation about setting a framework to unlock trading opportunities and investment opportunities in DRC. Just as a follow-up to, I think Peter's question was, what more can you do to expand that framework to enable other businesses tap into the same kind of opportunities that equity is also spearheading? Yeah, so what incentives can you spur or can you put forth to stimulate investment growth and unlock that multiplier?
Any other question? Very good. Mwathi.
Hi, good afternoon. Mwathi Kilonzo from EFG Hermes. There seems to be a big push from the government to make Kenyans start to save in more financial ways. Kenyans would save in land and cows, you know, the sort of things that pension funds cannot buy or fund, etc. So the question is what CBK and Treasury is going to do in terms of the capital markets, because if savings rates go up, then people need to be given the opportunities to invest in both equities and fixed income, whether that's privatization by the government or facilitating success stories such as Equity Bank coming onto the market so people can share in the growth of the economy.
Who wants to take the last, to ask the last question? It will be certainly the last one. Oh, very good.
Hello, my name is Linda Koskei from K24 TV, and allow me to take you back a little bit to the question that Mark asked earlier on. Not satisfactory for me because the PS mentioned on the tax policy framework earlier on, and I wonder whether that will factor in on this question. Equity is gladly and thriving in other nations, but there are companies that are actually moving away from Kenya because of the high cost of operation and many other things. Multinationals moving away from Kenya. will that tax policy framework, because most of them are also complaining about the tax regime, is that tax policy framework going to curb this? Or perhaps you can just give us a little bit of the details in regards to the tax policy.
Very good. So I think we can take those and
I didn't quite get the issue of the cross-border payments, sister. I didn't quite get it. What I did say earlier was that I think James also referred to it, is how we want to bring in the Pan-African payment system. And I think, given that we're going to this the Africa Continental Free Trade Area, I think that would be really critical for the country and really for making Nairobi a financial hub. And certainly later on, if we can also get, in the context of the East African Monetary Union, we can also get the East African Monetary Institute based here as a precursor to ultimately having the central bank for East Africa here. I think that would be very good and in the right direction. On the issue of the capital markets, I think really we just need to work more closely with people in the capital markets to see what impediments there are. I think on the issue of the privatization, the Privatization Act, I think that, in my view, should also resuscitate the market. I think the last time there was even an initial public offering in the stock market. I think may have been 2008, I think, with Safaricom. So I think there's a lot there to be done, but I think it's a matter now of listening to the industry and to see what more government can do to, to have capital markets. As you said, that's one area where you can have savings and investment intermediation. So it's very important. I know our savings rate is very low, and I think even this whole idea of having the housing fund, in terms of it now generating savings and having a higher savings rate, because a savings rate of 14% of GDP is just way too low to generate the kind of volume of investments that can really drive the country forward and have a lot of development. So somehow savings need to be increased so that to fund those additional investments. I think on the, let me just say something on the tax policy, and then maybe the PS representative can also add. The whole idea of the tax policy, national tax policy, which was, I think, now just approved by cabinet just the other day, maybe a month or 2 months ago, was so to have like a policy that stabilizes tax rates. So tax rates are not moving around, every year, and investors don't know what they make decisions on the basis of maybe a certain structure of taxes. Then after 1 year or 2 years it changes and it affects their profitability. So the whole idea of coming up with that national tax policy was to basically inject more credibility and stability in the tax regime. But maybe, I don't know, PS, you may have some additional observations.
Thank you, Dr. Tuge. I'll comment on the capital markets. As you're aware, the government is privatizing some of the state-owned enterprises in recognition that the private sector is better placed to do business than government is. And one of the avenues of the privatization we are looking at is the capital markets, because it's the most transparent and straightforward way of privatization. So we believe that should have a positive impact on the capital market, allowing more Kenyans to invest in financial instruments. We are also looking at pension funds. As you know, pension funds are holders of long-term capital. And in this case, we would like to encourage more pension funds to invest in the bond market. I think the bond market is in a bit of a slump, but this is an area that would be interested to address any issues that may be there, preventing pension funds from investing more in the bond market, probably less in land and cows. We would like to see the pension funds investing more in the bond market, because that is a very good match in terms of maturity. Bond markets are long-term, and so are pension funds. So that is an area that we expect that in the overall, the capital markets should be able to be more vibrant. Of course, we do recognize that high interest rates in a way dampen the capital market, but we believe that we should be able to get a balance between the high interest rates and the growth in the capital markets. Thank you.
I think from the private sector, we have seen particularly the digitization of the economy. The government has really asked the private sector, particularly the banks, to support in the 5,000 e-government payments. But the government has also come to us and said, why can't you connect the banks, the custodial system is in the bank, to the trading platform in the stock exchange? And I'm glad to say we have now successfully been able to connect that, and we'll be launching the trading of shares. So again, to make it, to bring ease and convenience in trading, and ensure that people can lead it and use these savings either in capital markets and the stock exchange products. And hopefully that will take the financial sector to the next level. Yvonne, is there any question that you felt from the private sector you could add? Perfect. Thank you very much. I want to take this opportunity on behalf of the entire team in the room to thank you, Dr. Thuge and Madam Kalen Kadir, for availing yourself this. It has been very interactive. It has really put perspective. And as we, since last night, talking about the investment opportunities in Kenya, the story couldn't get completed without us hearing the monetary and fiscal policy perspective and government policy. And I want to, as you can see, you seem to have exhausted all the questions that I tried to give because we still had more time, but we seem to have addressed the concerns. And broadly, we like really what the government is doing to create the wider market. We know the role Kenya played to bring DRC on board. We know the role that Kenya is playing to bring Somalia and preferably Ethiopia and Zambia on board on the East African community. That would then enlarge the market significantly. And Kenya would then have very significant companies. It's maybe we already, Equity now has merged latest data to be the largest company in terms of balance sheet in East and Central Africa. That is only possible because of widening, opening the markets and looping in the size of the market. We're now operating in a 300 people market. And I want to thank the government for this very great initiative. Allow kindly join me in giving it to our two speakers for every. it can get. So essentially, we are asking the governor to keep warm during winter. Governor. Helen. Keep warm during the
Pause, please. It's very rare to get them in the same room. Yes, it's very rare to get the central bank governor, who I don't think has done much media since he's taken the role with Treasury. So I think we're going to take about an hour's break. I think lunch is ready. Please enjoy yourselves, network. We'll start the afternoon with a presentation about the Equity Group business lines, and we'll introduce the management to all of you. So thank you, and have some downtime while you're networking and eating lunch. Thank you.
Opportunities abound in the Democratic Republic of Congo, DRC. The country is endowed with arable lands, rich mineral deposits, and an insatiable market for goods and services required by the almost 100 million population. In April 2021, President Uhuru Kenyatta of Kenya and President Felix Tshisekedi of the DRC signed a bilateral agreement that would see greater collaboration between the two countries. The agreement culminated in a 15-day trade mission to the DRC organized by the Kenya and DRC governments and facilitated by Equity Group.
I believe it is a moment of rare regional and continental pride as we witness our local enterprises coming together in the spirit of one Africa, one people.
And the theme, unlocking trade, tourism and investment opportunities in DRC and the Great Lakes region, the trade mission attracted more than 300 Kenyan investors, entrepreneurs and small and medium enterprises SMEs. The delegates first jetted into Kinshasa, a metropolis that is home to more than 16 million people. They were led by Kenya's Trade Cabinet Secretary Betty Maina, Equity Group Managing Director and CEO Dr. James Mwangi, Equity Group Chairman Professor Isaac Masharia, and the host, Equity BCDC Managing Director Celesta Mukeba.
We are very, very entrepreneurial. We seek new opportunities. And I've actually met Kenyans who have been in this market doing business for a while already. So this is, I think, for me, a great opportunity. And we present the opportunity in Congo as an opportunity for Kenyans to come and set up here.
The Kenyan entrepreneurs, captains of industry, and government agencies representatives were joined in the business forums, exhibitions, panel sessions, and site visits by more than 2,000 Congolese counterparts who were also keen to forge business partnerships.
J'ai la ferme conviction que la mission commerciale RDC-Kenya visant à rapprocher nos deux pays est de nature à renforcer nos relations en matière d'échanges commerciaux transfrontaliers facilités à ce jour par la zone de libre-échange continentale.
It's not every other time you get such opportunities where people open doors, actually walk in, see the opportunities, come back home and invite you to go and, see what is available for you to do. And you can see, this is a very big team. We have farmers here, we have engineers here, we have architects here, we have doctors here. It's a whole team. Just come and look for a niche for yourself, deliver on that, partner with the people on the ground, and you're good to go. It's a very good thing that Equity are involved in this, and I must say congratulations for holding our hands and bringing us. We have a time now to sit back and say these are the opportunities that we had, and this is what we did.
Giving a comprehensive prospectus of opportunities in the DRC, Dr. Mwangi said the trade mission was advised by the need for business decisions.
The Kenya DRC trade mission, we brought 253 Kenyan entrepreneurs. They are being hosted by over 2,000 Congolese business people. And the objective is to get Kenyan entrepreneurs to see the opportunity in DRC. The second one is to forge partnerships and collaboration with entrepreneurs of DRC so that we promote joint ventures.
Dr. Mwangi put in perspective the economic situation in the DRC, illustrating that the vast country is where Kenya was when only 6% of the population was banked.
DRC, from a financial sector, is where Kenya was in the early 90s. We're talking about 6% of the population being banked, 94% excluded. So this is a market we can grow very rapidly, much faster than we grew in Kenya, where we moved from number 66 to become number 1 largest bank in Kenya.
What Equity has done, I think, is one of a first, because Equity has been able to demystify the whole trade across DRC.
Kenya's Trade Chief Administrative Secretary Lawrence Karanja lauded Equity for partnering with the DRC and Kenyan governments for what he termed as part of a greater vision of the Africa Free Trade Area.
Kenya is keen to enhance trade relations through COMESA, tripartite, and African Free Continental Trade Area. And as I've said, we are pleased to welcome DRC into the East African community, because by so doing, we'll be having a market of more than 200 million people within the East African region. That is a market, and I will be asking the people of DRC and the people of Kenya to look at that opportunity which is coming.
We want more of this because it's bringing like-minded people together. What is also the missing link is normally money. How do you de-risk an opportunity? Working with Equity as a partner, we're able to understand off-takers, we're able to de-risk by making sure that the money is available, we're bringing like-minded people together. Equity is a lubricant in all of this. And by facilitating and going at different government levels, we're removing a lot of wrinkles and allowing us to do business. Just love it.
Comme dans
notre sphère.
Day-long discussions in sessions in Kinshasa, Lubumbashi, Goma and Bujimai addressed various topics with strong panels of experts analyzing their respective sectors. An exhibition site was annexed to the plenary where traders from both countries also had an opportunity to showcase their products and services. The delegates had an opportunity to network with their Congolese counterparts in matchmaking sessions and business site visits in all 4 cities. Equity BCDC MD Mukeba was at hand to discuss how the entrepreneurs can partner with the bank.
The DRC is a country of opportunity in the sense that the number of population, we are talking about 100 million people, and it's growing at least 3% per annum. So that shows the headroom in terms of growth, especially when we speak about 6% only the banking penetration. So 94% is the potential of growth.
It is refreshing to see that Africans are going to Africa, and we call them same as we call someone else investor. It is a very good thing. I love the mission.
Participants had a chance to interact and appreciate firsthand the opportunities that exist in trade, manufacturing, agriculture, mining, tourism, IT, among other sectors.
This mission is very good because it is also an opportunity for people of Africa to be together for that good business that we need to do between Africas. Equity Bank is now like a medium, like between us in our invest.
Kenya's ambassador to the DRC, George Masafu, expressed his satisfaction with the mission.
Kenyan businessmen are not coming here to do business by themselves. They're coming to partner with Congolese partners here. So the bank is also going to finance the Congolese businessmen, just as they're going to finance the Kenyan businessmen. And we believe that with strong trade ties, the relationships between our 2 countries are going to be very strong.
Speaking at the Lubumbashi leg of the mission, Deputy Governor of Katanga, Jean-Claude Kamfwa, thanked Equity BCDC for the initiative to bring the Kenyans.
Je tiens donc à saluer l'implication du groupe Equity Bank et Equity BCDC dans l'organisation de cette rencontre qui, reconnaissons-le, revêt toute son importance comme étape cruciale devant permettre l'éclosion d'initiatives régionales, favoriser les synergies et la création de valeur pour nos 2 pays et pour notre belle province.
Everything in Congo is an opportunity, if I have to say so. Everything is an opportunity. There's no field in this country you can tap in and not get successful. Everything, no matter what you think about. Because just take the population, 100 million. Who don't want a market of 100 million customers? It's already available. You think of agriculture, you think of education, you think of medicine, you think of all the fields are in need in DRC.
Equity Group Chief Commercial Officer Polycarp Igade said the mission has opened doors for Congolese entrepreneurs to visit Kenya.
We come to seek partnership. We come to embrace you, to give you a normal African hug, and to shake hands as equal partners. So we expect that there'll be a lot of business from DRC coming to Kenya and a lot of Kenyan business coming to DRC.
At the opening ceremony of the Goma conference, the governor of North Kivu, General Constant Kongbanima, said the DRC government is setting up economic zones to attract foreign direct investments.
Et vous souhaitez la bienvenue à l'occasion de la cérémonie d'ouverture de la mission commerciale Kenya-République démocratique du Congo 2021. En effet, cette mission organisée conjointement par la République sœur du Kenya et de la nôtre, regroupant plusieurs hommes d'affaires, tant kenyans que congolais, a pour mission la promotion et la consolidation des relations commerciales et économiques entre nos deux États. A conduit cette mission et aux hommes d'affaires kenyans pour le choix judicieux de la République démocratique du Congo comme destination de prédilection pour les affaires en général et en particulier la province du Nord Kivu.
Equity Group CEO Dr. Mwangi said the bank has set aside $5 billion for entrepreneurs to invest in farming, tourism, manufacturing, logistics, among other sectors.
There would be no better force of changing Africa than the business community. The business community, all entrepreneurs, organizes resources, takes the risks, and create products and services for the consumers, and in the process, they create wealth. The real cure to African challenge is wealth.
Citing Serena Hotel, Goma, as an example of cross-border investments, Dr. Mwangi said Goma and the surrounding region has a huge tourism investment potential.
Hasten your steps and invest in DRC. The tourism opportunity here is big. I was envious last night to see the hospitality in the lake. It's only by collaboration and partnerships that we can progress and take the continent to the next level.
East and Central Africa region has a long history of trade that has continued to the present. Indeed, the DRC is the sixth largest market of Kenyan goods.
Beyond having an embassy, we have now brought in a commercial attaché to confirm the importance of this region, Goma region. From the month of October, we started direct flights from Nairobi to Goma. When we started, we were doing 2 flights a week. Right now, we are doing 3. And we are looking forward to having daily flights.
Although the Eastern DRC has been the subject of news on insecurity, the delegates learned that intensity of conflict is low. In Bujimai, the governor of Kasai Oriental, Janet Muswamba, said Equity BCDC is an asset. She said the province has the longest section of the mighty Congo River and there are opportunities for investments in agriculture, mining, tourism, water and energy utilities.
Je voudrais également saluer les membres du gouvernement provincial et plus particulièrement celle des opérateurs économiques de ma province, dont la présence traduit tout l'intérêt qu'ils attachent à l'ouverture au monde, à travers les échanges commerciaux pour des conditions de vie meilleures dans notre espace commun.
The partnership between Kenya on the eastern seaboard of the Indian Ocean and the DRC on the Atlantic Ocean has opened age-old trade routes. For the delegates who participated in the trade mission, the initiative was an eye-opener that will herald a new beginning for Eastern and Central Africa.
Mkutano unakuwa nzuri kwangu kwa sababu ninakutana na entrepreneur wa kutoka Kenya na ninajua kama tutafanya partenaria, ile tunaita partenaria, kwa sababu niko frame international, najua kama nitakuwa international kabisa kwa sababu pamoja na entrepreneur kutoka Kenya tutaungana pamoja na tutaendelesha uchumi wetu kwenye Kongo pia na kwenye Nairobi.
I would like to add the Kenyan population, the people who can do business here in Congo. There are a lot of opportunities here. Please come and let's move together. Let's exploit these opportunities so that we can move forward as a
as a community in Kenya.
A big appreciation to the government of DRC and to the government of Kenya. First, bringing 250 companies from Kenya to come and see the opportunities here. And Equity BCDC being able to show us the way, telling us we've been here before 7 years, this is how we've been able to prosper, this is how we've been able to transform lives in this economy, and telling us, come, we want to do business with you. That is not something to be taken lightly, getting all of us here.
This was a very good call for both countries, and especially I thank Equity for facilitating this, because for many participants I've been able to talk to, is an eye opener for them.